Morning. If everyone can start taking their seat, we're going to get started in just a couple minutes here. Thank you. We're going to get started in just down to a couple minutes. Please take your seats. Thank you. Yeah, we're 8 o'clock. Yeah. Is this on? Test, test. All right. We need to get seated, please. Hey, Debbie. Good morning. I know we got a full house here this morning. Everyone, yep, please take their seat. We're ready to get started. Yeah. All right. We have a very full room this morning, that's for sure. Thank you. All right. Thank you. Well, good morning and welcome to our 10th annual Manufacturing Outlook. Hard to believe it's been 10 years, right? Wanted to thank you. My name is Tom Alongi. I lead up the firm's national manufacturing practice. Think differently. You saw it on that slide, right? Interesting. Does anybody remember when the first iPhone came out? Anybody know? Fall of 2007, right? And what happened in 08 and 09? The world felt like it came to an end, right? A lot of companies went into sustaining mode. Apple went into innovation mode, right? Even during those times, we saw long lines waiting to buy that iPhone. Innovation drove through even in the greatest recession we've ever had. And maybe we're feeling a little cough in the air. Will it turn into a flu? We'll find out. We'll talk about it. But ultimately, it's innovation that'll drive our future. And why do I say that? I've been doing this for, like I say, 10 years, and I've been thinking about, we walk through, our team, probably at least 100 plants a year, manufacturing plants. And what is it that we don't see? You know, we see a lot of companies, right? Getting productive, right? Cutting costs, lean manufacturing, right? But not enough middle market manufacturing companies are innovating. Innovative products. It's not every company. We're here today, we're going to meet some of those companies that are truly broke out of their shell and became innovation companies, right? But what do we hear? Innovation. I don't have the resources. I don't have the people. We hear all the excuses, right? And we have been dealing with a lot, right? And you think about, we've talked about this. This is in years past, right? It's probably the number one thing that I see, that our team sees, right? Global competition. How many times does the phone ring? Tom, we got a costing problem. Tom, how low can we go? Tom, target pricing. Tom, China, right? Prices down, price pressure, and what do? We keep giving in. And then you throw in the jobs factor. We had a whole session on this several years ago. Not going to go away, and we've been trying to combat it with what? More productivity, more efficient equipment, wringing out the costs, right? We see it. You see the charts. I don't tell you. Productivity up, employment down. Absolutely. It's a risk we're all dealing with, and we're going to continue to deal with. The economy and political environment. Nothing new. Going to have it. David Sowerby's here today, right? He's going to talk about tariffs, the economy, what's happening. Absolutely. Always going to deal with that. And now we throw in Industry 4.0. And Plex is here today to kind of take us. We did a whole session on Industry 4.0 last year, year before, And, but that's still evolving. So we're gonna talk a little bit about 4.0, connectivity, but guess what? That's another level of investment, right? Costs up. Is it smart factory? Is it an app for that? How are we connecting, right? So we're gonna learn a lot about that. And then finally, why we're really here today is this lack of proprietary products that I see in these middle market manufacturing companies. Yet we hear about all these startup companies disrupting, right? But we don't see it enough in our middle market manufacturing companies. And maybe we need to know how to innovate. All these factors that you see here today, Thomas Stewart is here from the Center of Middle Market Research that is really going to talk about a lot of data. It's an amazing what his team has put together. And we're going to talk about all these factors and how it's impacting middle market. But the bottom line is, what does this all feel like, right? It feels like a race to the bottom. Doesn't it some days? We've been wringing out the costs. Where can we cut? Lean manufacturing, OEE, everything we do, right? We're just trying to sustain, right? We need to think differently. And the problem is you might just win. And our job is to make sure that's a race you don't win. And that's why we're here today, right? Is to make sure that you're thinking differently so you do not win this race. Because we're spending too much time figuring out how low can we go, right? So where do we got to go, right? We got to work on this path to innovation, right? And our team worked on this, and I mean, it's really, to me, if there's one slide you walk away with, it's really this. And where are you on this matrix, right? Level of technology on the left, level of market innovation. We added the customer experience, what seems to be growing, right, in importance. Well, my other vendor does, I can go online and I can see this, or I can get it on their app. Well, you don't do that, right? So that is going on. And the one thing we didn't even, I thought that we should have added, even along on the other side there, is market multiples. Because as we move up that high risk, guess what? We want to talk about creating value. That's where we create value, right? And we've been down in this, sustaining mode, right? As we talked about, cost reduction, wringing it out. And this morning I got from Industry Week, we need to stop talking about lean. I can't make it up. I just got it. It's like, it is. We still do. But the point is that we've been talking about this for decades, right? And we need to really, this is where Industry 4.0 really comes in. This is where I know our middle market manufacturers can innovate. They can. So we need to move into this upper quadrant, right? And move into these disruptive phases of disruptive to the organization. And, is that an internal investment? Is it getting rid of legacy systems? Could very well be, right? Or can we think about how we move to the very top? How do we have breakthrough products, breakthrough process? And we're here today with a few of our clients, RCO Engineering, Continental Structural Plastics, two middle market companies that found a way to innovate, to break through that sustaining of how low can we go. And we're going to talk with them today. Pretty excited. But we need to have a roadmap, right? We need to have a roadmap. So ask yourself, are you an innovator? Are you a product disruptor already, a market disruptor? Maybe we have a few in the room. Maybe you came to the wrong conference. But we know that's not. The case really is what should we be considering, right? And do we have the right team and That's a huge one. That's a great starting point. And that's why we have our clients here at RCO to kind of and talk through that. What did they do? How did they assemble the right team to become an innovation company? Or what internal investments really need to be made? Not equipment, but what are the soft costs when you think about Plex and Internet of Things and connectivity, right? And I can get real-time data. I can make decisions faster. Maybe that's a first step, right? Or what product or a process that we may make can we disrupt? And I can tell you, I am really, really excited to have here what Twist Think. Bob Nemiak that I met with this past summer, I said, Gordon Fulmer introduced him to us. And I said, wow, where have you been? Right here in Holland, Michigan. They are a product innovation company. They help companies innovate. Really, really exciting. We'll talk through that. So, or do we have to buy scale to innovate? CSP, we think about, I was on a journey with them since 2010. Unbelievable leader there, CEO, Frank Macker said, we're too small. We need to get bigger, and we need to buy an innovation company. And they bought a company in France, Carbon Fiber, that helped them innovate, take weight out of their products to be competitive. And it just grows from there, and we'll hear their story. Or is it that we're just stuck? Yep, had lots of conversations with clients and prospects. Where are you going? What is your path, right? Are you a target for consolidation? Yeah, we've had a lot of sales of companies, and maybe that is the right choice for your path to innovation, right? We have a lot to talk about today, and the lineup of speakers are very, very excited this morning. I think it's one of our top programs that we put on ever. So, but as we think about disruption, I think about it also in our own industry, and lots of startups want to disrupt what we do, commoditize the audit, have robots prepare your tax returns, right? I'm just saying, but what they can't take away, I hope, is a great advisor. And I truly hope that you see our passion for your success. It runs deeper than just keeping score. It really does. We really want you to help you to think differently. So that's our goal, and we're ready to get this program started. I'd like to welcome up David Sowerby. He's one of the managing directors for Mancora. He needs very little introduction. You've probably seen him on CNBC, read about him in Cranes. He's been presenting with us for many years here.
Too many.
Hey, watch it. And Ancora,
No, I mean for the audience.
Oh, yeah, all right. So Ancora has over $7 billion in assets in Bloomfield and Cleveland. And David's been involved, obviously, he's on the investment committee for the Detroit's employee pension, and also on the Beaumont Hospitals investment committee. So I'd like to welcome David Sowerby.
Perfect. Thank you, Tom. Perfect. So we've had this conversation for 10 years, right? And the pledge is this: if I can't give you my thoughts on the business environment for the next 12 to 24 months in 20 minutes or less, shame on me. And if you walk down the history of this event, 2009, you're sitting here, You're starting to get the green sprouts in the recovery and business and a near death-like experience in late 2008, early 2009. And you could talk about the green sprouts in the fall of 2009, but it took a lot of show me in that environment. A couple years later, segue into the conversation developing, and the real theme was what I've talked about quite a bit, is what we call the rebirth or the renaissance in manufacturing, particularly in the Midwest, and as it relates to Michigan. And then here we are in 2019, and I'm here to tell you that on a secular basis, the rebirth is still firmly intact. If I shape this in what I'll call macro meets micro, a lot of it is macro, but as a portfolio manager, I really look at it bottom up, individually. What are companies telling me, and is that ratifying what I'm seeing at the micro level? So here we are, last 10 years, pretty good rebirth in manufacturing, productivity, et cetera. I'll get to that chart in a minute. I'm going to apologize. It's way too busy, but it'll speak to the topic at hand, which is tariffs and trade. So the last 12 months since I've been here, there's certainly been a deceleration in manufacturing. I always warned you that one of the years I would come here and maybe not give you as robust a view as what I have in years past. We're not quite ready to say the dreaded R word for recession, but I think unquestionably in the last 6 to 12 months, even a bit longer, there's been more deceleration in manufacturing than any time in the last 10 plus years on a cyclical basis. Front and center, no mistake, it's tariffs, right? It's trade, it's uncertainty. You just look at CEO and CFO confidence surveys, and they're low, and it's being ratified by some of the uncertainty in the numbers. And anecdotally, if I was listening to a company's conference call 12 months ago, it was very robust. It was talking about what they're going to do with their tax cut. In the current quarter we're about top of the third inning for earnings season. Tag that along with second quarter earnings, and more of company commentary is about the impact of tariffs and trade, uncertainty, and what it's doing. In particular, we'll find out what it's doing to manufacturing. So a little more sobering conversation this morning on a cyclical basis, with the bright sky being on a secular basis. It's still pretty darn good for manufacturing. And God forbid anybody tries to forecast a recession, because if you did, in 2014, it was going to happen in 2016. In 2016, it was going to happen in 2018. In 2019, now it's more likely, best thoughts, late 2020, mid 2021, at least for what I try to watch to give a forward gauge. What's still right is, in spite of the tariffs, the tax cuts and the indirect tax cuts from sensibility on regulation still supersedes what we're seeing on the tariff side in the uncertainty. Michigan, I've always contended in this conversation, is in a much better place to compete. And news as recently as yesterday in terms of our competitiveness just out from the Tax Foundation continues to reaffirm that. Last, to tee it up, is when I see companies from what I call corporate allocation or corporate capital discipline, they're still pretty darn sensible on how they're spending their cash, whether it's share repurchase, dividends, M&A, CapEx, you name it, they're still judicious. And what I really want to avoid is not a very affectionate term, is when I say they start spending like drunken sailors. So here we are. I think the secular story is still very much intact. I see it in publicly traded companies. For what it's worth, there's about 200 companies in the S&P 500 that, let's call it, they make something. And if you look at those 200 companies, obviously larger in size, but those companies that, quote, make something, there has been an absolute untold story that continues to unfold in what's happened with their operating margins And a number I pay even more attention to, their free cash flow margins, where it has been a terrific story. And that comes even in spite of the last 24 hours when I get a little bit of a cold shower from Texas Instruments last night or Caterpillar this morning, giving a little more sobering guidance. I think the secular story is still intact. So if we pick up the pace here in my spirit to have this conversation in 20 minutes or less, you've already looked at my first chart. I won't go into it. It's arguably a little too busy, but here's the key. 2018, companies were talking about the beneficial aspects of the tax cut and what they were going to do with the cash in the wake of the tax cut, and that was the dominant theme on company conference calls when they were giving their earnings and revenue estimates. Now we're starting to see, really since second quarter, maybe first quarter this year, a lot more concern over tariffs and trade. The bottom line is incrementally now the tariff and trade costs are starting to dilute the positive impacts of the tax cuts. And it shows up in particular in manufacturing. I don't love too many charts, but this one I think really drives it home. When you look at average weekly hours worked in U.S. manufacturing, coincidentally, it peaks in May 2018. The tariff tweets and talk really began to intensify in March of 2018, and you began to see it in CEO, CFO uncertainty. We don't like uncertainty. Nobody does. And what do when it's periods of uncertainty? They slow down their spending, and in particular their CapEx. Out of the still pretty good free cash flow they're generating, CapEx has been much slower. Now, I can't predict tariffs and trade and politics at all. I always think as a portfolio manager, if I manage money thinking government's going to do the least amount to fix a problem, that's probably the best and only starting point I think about when it comes to managing money and picking companies. But having said that, we're a year and a half into this whole tariff environment. The rule of thumb is the average trade war lasts 4 years. The other rule of thumb is, I won't go into the history, but if you go into Investo or Pedia and you Google the Long March, China, 1934, interesting piece I read. The Red Army marches 5,000 miles to evade the Nationalist Army, and you lose more than 80% of your troops. I think that's a pretty good data point for how long this trade on-again, off-again discussion is going to continue to go on. At least the needle has moved a little bit better in the last month, but I don't think we're out of it. And I'd say go Google that Long March in 1934 just to see how long this stuff can go on for and the fortitude of the Chinese population. So let's get to the good stuff. Sensibility on regulation. I remember in the summer of 2016, the president came to the economic club here, and he had 3 main points: tax cuts, sensibility on regulation, plus, tariffs, trade, let's call it a minus. And when it came to regulation and sensibility, it's hard to measure. This is a pretty good way to measure it. The Federal Register is the number of pages as it relates to regulation. Look how it peaked prior to this change in administration. It's come down. It's an indirect tax cut. I'm sure anecdotally, you can tell me more than I know about how it's maybe gotten more sensible, whether it's in banking, energy, building and trades, even in healthcare, it's gotten more sensible when it comes to the regulation. That's an indirect tax cut. That's very good. And I think that's still the secular improvement that's helped out manufacturing. Quickly segue into our favorite industry. Autos are still, from a profitability standpoint, whether it's free cash flow, return on invested capital, the important measures, auto companies are still hanging in there pretty good. We're still selling 17 million cars and light trucks. We're producing about 2 million cars and light trucks in the state of Michigan. The good thing there for the state of Michigan is out of those 2 million cars and light trucks we're producing, 1.5 million are light trucks, 500,000 are cars. We know the profitability and the margins are in the light truck business. That's what people want. And I think that bodes well for the state, and it's still pretty darn good. And we've seen too often when the Wall Street auto analysts have been willing to start to write the cyclical decline in the auto industry, they've continuously got it wrong, including the most recent data point, and that's because the average age of the car is old, scrappage is going up, and cyclically, real income after inflation and taxes is still growing close to 3%, and that's been a good thing. And while the stock prices haven't quite made you money, because I'd still contend Wall Street still has a very dour view of the industry from a return to shareholder, though we can question that. Certainly the profitability, whether it's sales growth, return on equity, return on invested capital, when I look at a sample size of 16 auto companies, is holding up pretty good compared to the broader indexes. Now, I did say that growth rates have slowed. So I like to do this scorecard. And if I was having this conversation 2 years ago and I was looking at Michigan versus the US, and I looked at some of our metrics, you can read it better than I can say it, but run down the list, you'll see that most are outperforming 2 years ago, fall of 2017. The most important to me is the one at the bottom called prosperity. It's nothing revolutionary. I just take prosperity and I call it income growth and job growth. Pretty darn simple. And I've looked at this for many years. And you can see in the fall of 2017, we're growing faster than the US. The rest of the variables, pound for pound, faster than the US. Now, fall of 2019, and with the exception of home prices, we are trailing, right? Goes to my story of the last 12 months, there's been more deceleration in my more sobering part of this conversation than any time in the last 8, 9 plus years. So that prosperity measure is growing slower. I think a lot of it is just simply stage of the business cycle. Some of the delayed impact of the Federal Reserve being a little tighter, but I still contend to most companies, the weighted average cost of capital at about 3% is still pretty competitive and conducive to grow your business. But on a cyclical aspect, we are starting to slow. We don't like to put these numbers out. I don't like to, but the numbers are the numbers. And that's had an impact. And the trade issue has been front and center for a lot of manufacturing companies. A little closer to home, as much as we focus on China, it's just as important, if not more important, to think about what's going on with our trade issues with Canada and Mexico, right? As a state of Michigan, about 6% of our exports go to China. Canada's 40%, Mexico's more than 22%. Pay a lot more attention to what's going on with the US, Mexico, Canada free trade agreement in the aftermath of NAFTA. To me, that matters a lot more on a secular basis. Pound for pound, not too bad, but there's still some question marks in that trade agreement. One is every 4 to 6 years you get to revisit it or review it. If I'm a CEO or CFO, I want to have certainty. I don't want to have to worry about, well, what's Congress going to do to muck this thing up if every 4 or so years, 5 years, they get to recalibrate it. Think about NAFTA passed in 1994-95. How many times could they have recalibrated NAFTA, and what does that do to you from a business perspective? The story on a secular basis still gets pretty darn good for manufacturing and our ability to compete. I've had this theme the last few years where we talk about Michigan cyclically doing well. We know it's slowing. Secularly, much more positive. So my favorite is still the Tax Foundation. Every fall, they come out with a ranking of the 50 states in competitiveness. And guess what? Data hounds like me try to watch this stuff when I'm not listening to Texas Instrument conference call on my way down here, replay this morning. And the good thing is, just checking this thing out, it came out yesterday. So if you go to the Tax Foundation, like a data person like me, you can pull it down, and guess what? Michigan ranks 12th in competitiveness. Really amazing to me is, you know who ranks number 13 now? Texas. I don't know if I ever thought in my business career the state of Michigan would rank better than Texas in competitiveness, and yet now it does. The bogey maybe still is Indiana at number 10, but there we are, we rank number 12 for major taxes, sales, most competitive, personal income, flat. Protect that with your life. Don't let anybody in Lansing muck that up. Corporate income taxes, we know we're horrible. We're in the game. Unemployment insurance, property taxes, we rank number 12. And to help ratify that, other measures put us in the same category, and I think that's pretty darn good. Now, I said we talk a little bit about tariffs and the uncertainty. This drives it home to me in my world. The tariff issue started to really percolate in March of 18, on again, off again, on again, off again. Maybe a little better the last couple of weeks, but we still need to see the numbers. But if I go back to March of 2018 and I get a little too granular in data, the median stock in the S&P 1500, not the 500, the 1500, large cap, mid cap, small cap, so I get a much better sample size. The median stock is pretty much flat. Uncertainty, people run to safety, 10-year treasury. I'm not going to make any money in that at 1.8% net of inflation and taxes, but in the last year and a half, people have run to that environment. That, to me, along with that manufacturing hourly numbers, really measures this uncertainty of this tariff issue. And as much as you want it to go away, I think it's going to go away. So in the last few minutes of this conversation, I'll try to drive it home in the micro. At least what I look at in the market, beware of the investor who tries to make a 12-month forecast. It's impossible. You're going to be wrong more than you're going to be right. The rule of thumb, when everybody's talking about the next year, is always, simply put, Wall Street strategists run like sheep in a herd. They'll always say it's going to be 9 or 10%. The rule of thumb is either bet the over, bet the under, which is in a single calendar year, it's usually going to be better than 13 or less than 6 or 7. 2018, bet the under. 2019 wasn't too heroic to say in December last year, bet the over. And S&P 500 up 20% this year, unless we really hit the skids, is going to be a bet the over year. So you can try to make an assessment on the next 12 months. I try to look at these things at least like any investor. If I buy a stock, I want to own it for at least 3 years if I've done my homework right. If I want to have a view on the market, it should be the same kind of thing. And I still see a little bit more mildly positive than negative. So you can read the traffic signals in auto lingo better than I can. 2 I'll just focus on is investor optimism. Always run, don't walk. When you're getting stock tips from your Uber driver and your bartender. And when investor sentiment gets unusually bearish, it's time to be courageous and go do some shopping. So here we are today, and I don't think investor sentiment is unduly bullish. That's a good thing. For what it's worth, last year, at the end of the year, it got really bearish, which was probably, among other things, a good sign that 19 would be a good year for the investor. The other one that I give the green light to is what I alluded to before is when I worry about companies being, as I said, affectionately spending like drunken sailors. You know, they're still pound for pound judicious in their capital allocation. I can lament that the Texas Instrument number last night and the Caterpillar number this morning is, another sign that we're farther along in the cycle. But for most of the companies that have reported so far, and not to get quarter by quarter, but pound for pound, the free cash flow that companies are generating is still healthy to me. How they're spending that free cash flow makes me more encouraged than not. Free cash flow margins at better than 12%, still pretty healthy and hasn't decelerated. And those are all pretty good things that set the backdrop that says that from an equity investor's perspective, it's still pretty good. And while manufacturing is slowing, I can still find wonderful opportunities, whether it's a large cap stock I own in the mutual fund I co-manage, like Honeywell or Eaton or Level 3 Harris, all long-term holdings, good. And in small caps, SPX, that used to have its headquarters here in Michigan, that's a diversified manufacturer industrial company, pretty darn good. Arcosa, we like to buy lots of spin-outs. It's really an infrastructure play, good. The micro is still meeting the macro in terms of opportunities on a secular basis based on what the micro is telling us in companies. Now, you may be de-risking a little bit. I'll finish up this way to say the rule of thumb used to be, okay, if I'm de-risking for the last 30 years, what do? Reduce my stocks, maybe do it a little bit cyclically, and I go buy bonds. And I'm going to quote my favorite portfolio manager, Lee Corso from College Game Day. Not so fast, my friend. Because at a 1.8% yield on a 10-year treasury, take away inflation and taxes, I'm not gonna retire on the beach. I'd say too much, I'll be next to the freeway if I take that path. So all you have to do is look at the secular low, and nobody can forecast interest rates. I used to be a bank economist. I haven't been one in a long time. Used to try to do that. Thought I was okay at it, but more often than not, you're wrong before you're right. But at least if you look at the secular low in interest rates, summer of 2012, summer of 2016, now late summer of 2019, and you look at the forward return of the bond market, it's not too exciting for the old adage of de-risk, sell my stocks, buy some bonds. Not so fast, my friend. And you got to be a lot more clever in that environment. And if you think about what the macro environment and meeting the micro environment tells me is from manufacturing, sure, last 12 months, more slow down, if that's the right term, than I've witnessed in 9 years. And likely to continue, but at least positive growth through sometime in 2021, I'd say. And when we look at the micro, and we look at what companies are particularly doing with how they're judicious in their capital allocation based on the still positive trajectory in free cash flow margins, because I think there's no silver bullet, but when I hear a company talk about its intent to grow cash flow from operations and free cash flow, then I know I'm talking to the right CEO and CFO. That's still pretty darn intact on a secular story. So if I did my job, then I kept to my 20 minutes or less. A Cranes reporter a long time ago, this guy Matt Roush, told me, Dave, nobody boos you for a short speech. So I'll stop there, see if we have any questions, and we'll keep this event moving along for just the nice opportunity to always be here with my pals at UHY. To see if we have any questions. This is the awkward moment when Sowerby goes, who's my friend who's going to ask me a question? Yes, sir, in the front here. This gentleman has a question.
The S&P 200 that you watch closely.
The 200 stocks in the S&P 500 that make something.
Right.
Yes.
What were the two things that you felt apparent on?
That they are still generating healthy free cash flow margin, and that when it comes to how they decide to allocate that free cash flow, I think they're a lot more shareholder friendly, which tells me that the cycle still has legs from a micro perspective. When they're not spending like drunken sailors is when they're not doing too much capital spending, or they're doing what we would like to call value-destroying acquisitions, which is just simply put, dumb deals. Think AOL, Time Warner back a long, long time ago. So 200 out of the 500 make something, like TI, CAT, but more than that. Yes, sir. The short answer is yes. So if we get some resolution with China, is that going to be good versus not? I don't know what the outcome will be, but I think it's good because it removes uncertainty, and people don't like running their business in a period of uncertainty. So that ends up being good. And that's about the extent that I can ever predict. Right? As I like to say to my kids, stay in your lane. If I say it to my wife, it doesn't quite get received quite as well. But I'll stay in my lane and say from trying to predict politics, it just removes uncertainty. I don't know how it's going to turn out. All right, let's keep this show going. And as always,
David, thank
Tom,
you so much.
thank you so much.
Thank you.
You bet.
Always great. Our next speaker, really, I've been to a couple of his presentations. I think you're truly going to love this. Lots of data points, as us as accountants love. But also, I did want to mention the slides that you see will be available on our website, but we will also be emailing those out in our thank you letter. So you will be receiving those. Thomas Stewart is the Executive Director at the National Center of the Middle Market. So the National Center of Middle Market was founded in 2011 in a partnership with GE Capital and is located at Ohio State. I'll let him elaborate on that. Don't know how that's going to go over, but we'll let him, but the center really is a leading source of research for the U.S. middle market economy. And the data set points here are really, really spot on. It really resonates with our industry practice and where our firm is focused on. So I'd like to welcome Thomas Stewart up. Thank you.
Thank you, Tom, the magic power here. I'm delighted to be here. Just to make sure that people understand that though I am at The Ohio State University, my daughter has her doctorate from a vocational technical school in Ann Arbor, and actually and teaches in Ypsilanti at Eastern Michigan. So I'm allowed to come here. I mean, I've got a visa and a MasterCard, and so I am allowed to be here. So I'm going to talk to you a little bit about two things. First of all, I'm going to pick up on and maybe comment a little bit on what you just heard from Dave. One of the things we do at the National Center for the Middle Market is we have a quarterly middle market indicator. This is a survey of 1,000 middle market companies across industries across the country, from $10 million in revenue to $1 billion in revenue. I'll come back to that in a second. Every quarter we ask them, how's business? How's your growth? How's your revenue growth? How's your employment growth? What's your confidence? What are your investment plans? What are your challenges? What's keeping you up at night? So on and so forth. The third quarter 2019 middle market indicator was released an hour and 15 minutes ago with data collected in the first 2 weeks of September. I'm not going to go through all of that. I'm going to just skim a little bit of the surface of that. And you can find it on our website later if you are so inclined. In that middle market indicator, there are about 200, seems to be the magic number today, about 200 middle market manufacturers. I'm going to carve out some of the manufacturing data for you there. I'm also then going to spend, I guess, 2/3 of this talking about a study that we did a year ago, going in depth into middle market manufacturing and describing some of the challenges that manufacturers face that are more of a secular challenge than they are of a cyclical challenge. I like your distinction. I remember when I was at Harvard Business Review, we sometimes talked about management issues that were structural or secular, cyclical or self-inflicted. And we have, in some cases, some self-inflicted things too. But I'll talk a little bit about some of those secular and self-inflicted challenges that manufacturers face, and we can put those into the economic context altogether. One of the things, as David was saying, is that the most difficult thing about the future is predicting it. I think it was Niels Bohr that said predictions are very difficult, particularly about the future. And as we have been conducting our middle market indicator survey for the last 8 years, we basically came into being as we were coming out of the financial crisis, and we've been looking at a long boom. We've been looking at, but a slow boom. I mean, sort of an economic climate that is not unlike Bermuda. not too hot, not too cold, a little bit of rain, a lot of sun, beautiful sand, Bermuda shorts, pink sands. It's really been a very nice time. Labor costs haven't been too high, energy costs haven't been too high, interest costs have not been too high. It's been a pretty benign environment, and it's getting a little rockier. Sidebar for just a second. When I said I want to define the middle market for you, because that is a question I didn't answer that most people ask. When we set out to do the middle market indicator and to set up the middle market National Center for the Middle Market, that was question number one. What is the middle market? We went to census data and tried to find what's the middle third of the private sector. And if you look at the middle third of the private sector in terms of revenue, that gets you a couple of 100,000 companies with revenue between $10 million and $1 billion a year, give or take. It's probably moved up a little bit because the economy's been growing since we started doing that. That's a big spread. It's 2 orders of magnitude, but these companies are bigger than small. They're smaller than big. My wisecrack is that they are too big to be exempt from regulations and too small to buy a congressman of their very own. The middle market does tend to over-index to manufacturing. About 17-18% of the middle market is manufacturing versus, as you know, about 12-13% for the economy as a whole. So middle market manufacturing is the core of the middle market, and I think you could argue that it is the left ventricle of the U.S. economy. It really is where the heartbeat comes. It's you guys in this room, the people you work with, and the people you work for as middle market manufacturing. So how's business? If we look at what has happened in the last quarter, for 8 years, we've been seeing this Bermuda-like thing with very strong, robust growth. I'll show you some trending numbers a little bit, but we really see a significant drop in annualized revenue growth. The revenue growth rate, I'll start with confidence in the U.S. economy, and I'll show you some other confidence numbers, but confidence in the U.S. economy has fallen from 82 to 76%. A short-term index, which looks for the next 3 months. The short-term index is composed of what people are saying about the business climate in the next 2 months, the net of positive and negative, demand over the next 3 months, net positive and negative, and sales, their order pipeline over the next 3 months, again, net positive and negative. That has dropped to the lowest since we've seen it, so people are saying the next 3 months are going to be kind of wonky. Their revenue growth on an annualized basis fell from 8.3% to 5.8%, and employment growth from 6.4 to 4.1%. Now, this is an annualized revenue growth, so if you see 1 quarter drop from there, that sort of suggests that there was some deterioration and you just lopped off a really good third quarter of 2018, and deterioration that had been there but masked has sort of emerged. Here is the trending number, and you can see the manufacturers. I do have to emphasize here, the big companies here are in this ugly blue color. The middle market companies and the manufacturers are in this attractive scarlet color, and I just do need to point that out, and I'll stop now while I can still get out of the room intact. But what you see here are the trending data for the S&P 500 below with revenue growth. It's not stock market, it's revenue growth. It's kind of odd that the S&P 500 revenue growth bumps around that much. I would thought that big companies could manage their earnings a little better than that. Actually, they probably manage their earnings better than their revenue. But then you see the middle market companies across the top. I want to call your attention to that bump right there in the middle, which is the first quarter of 2017. That's an anomalous high. And when I look at this third quarter of 2019 with this drop, my first question is it an anomalous low? Is it going to bump back up? It's odd in a survey of 1,000 companies that you should get that spike, but if you look, you got revenue growth of 6.8 and 6.7 on either side of that mountain. It can happen. So what we don't know is whether we've got a trend or a blip. When we look at this third quarter of 2019, the first not, to be sure, not too fast, sort of look at this. Here is the trend in revenue and employment growth for manufacturing. This is a bit of an eye chart, but one of the things that's interesting about middle market companies in general, manufacturers as well as everybody else, is if you say, how was your last 12 months? They'll tell you, oh, it's great, we grew 8%. What's your next 12 months going to be like? They say, oh, it's going to be 5%. They always underpromise and overdeliver. That's partly because 85% of these companies are private. They don't have to try to set and therefore set a Wall Street expectation. And so they tend to be, they're conservative and cautious by nature. If there's one thing I'd say about a middle market company is their single biggest fear is out driving their headlights or getting out over their skis. They just do not want to, they tend to underpromise and overdeliver. But what you see here is you actually see in this quarter that for one of the unusual times, revenue forecasts and employment forecasts matched. The revenue delivered matched the forecast from a year ago. But you can sort of see this trend over time, and you can also sort of see a somewhat, if you try to take a look at the shape of these curves, you do see something that looks like it may be going down a little bit. Dig a little further into these numbers, and you can take a look at the amount of who's growing and who's not. This is again second quarter and versus third quarter, and it's and the middle market as a whole on the left, and the middle and manufacturers on the right. The first thing you notice in this is if you look at the number of companies that grew 10% or more in the last 12 months, in the middle market as a whole, it dropped a lot from 38 to 28%. And the number of companies that grew 10% or more, we call them growth champions, is equal to the number of companies that were either flat or shrank. In terms of their revenue. Manufacturing, you'd see a situation that is a little different. The number of high flyers did not diminish as much, but the number of submariners, or the number that were flat or lost revenue increased more than for the middle market as a whole. But overall, the picture there is that the composition of growth within manufacturing looks a little bit better than the composition of growth within the middle market as a whole. I think that's partly brought down because retail has had some tough times. Construction is looking a little bit, having been a really high-flying industry, is looking a little less strong than it did. I also like to look, one of the questions we ask is just an overall subjective, how's business? Compared to the last year, are you doing better, the same, or worse? It's a winners or losers question, and we let the people define what better or worse. We don't ask for profitability. We just say, is your overall company performance better, the same, or worse? And what you see here is, again, a drop in the number of companies that say business is better. And that shows in manufacturing, and it shows as well in the overall middle market. You show the drop is less severe in manufacturing. You see a very slight increase in the number of companies that say performance has got worse. Over the last year, that number has gone, it's been 5%, 6%, now it's 7%, 6%. So the number of companies that say business is getting worse is very small, and in manufacturing, it's smaller still. At the same time, confidence is dropping across the board. The three lines here are confidence in the global economy at the bottom, national economy in the middle, local economy at the top. Middle market companies tend to be local champions. They know their local economy. It's like walking down a dark street in a city you know. You feel a lot more confident than walking down a dark street in a city you don't know. But we see a general trend, a general dropping in confidence. Trade war has to do with some of this. Brexit has to do with some of this. Slowing growth globally. The IMF's recent forecasts about international economic growth are some of this. But you also see a diminution in confidence in the local and national economies as well. Well, question we ask companies is, if you had an extra buck, this is the revenue fairy. The revenue fairy comes and gives you an extra $1, what would you do with it? And would you put it aside, or would you put it immediately to work? And if you would put it aside, would you put it aside as a cushion, or would you put it aside as a war chest for future investments? Here is the pie chart for the third quarter of 2019. A couple of things about this. The number, that 44% that say they'd put the money aside is the highest we've seen in a long time. The lowest we've seen is 29%. So mostly, as I said, these guys tend to be conservative. They like to carry their like a camel going into the desert, they like to carry their water with them. They like to carry a fair amount of cash, and they like to fund investments from retained earnings. But this is a very cautious picture, and the ratio of companies saying that they want to put it into a safety cushion as opposed to a war chest has changed. About a year ago, it was a little bit more war chest than cushion. Now it's more cushion than war chest. Manufacturers, you see a more robust picture. I think it's partly because manufacturing is inherently more capital intensive, so you need to be doing more investing to continue to grow. But you again, I see a similar picture with a rise in the number of people who say they'd put this money aside either for a war chest or for future investments. The question then becomes, we also look at not only what you do with this mythical extra dollar, but we also look at plans. What are your plans for the next 12 months? And these are plans for different kinds of expansionary activity. Will you add a new plant or equipment? Will you introduce a new product or service? Will you expand into a new domestic market? Or will you expand into a no international market? Or will you make an acquisition? And what you see here over the last 4 quarters on the left-hand side is you actually see for the first time, for a long time we were seeing anxiety, 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 but our plans have not changed. We're continuing full speed ahead, even though we're nervous as hell. Now we're starting to see some cuts. And in the middle market as a whole, there's some interesting thing is the biggest drop is in the number of companies that say they expect to make an acquisition in the last 12 months. I think that's a good sign because it says we're pulling in some of our investment, but what we're doing is we're focusing on our core business. We're going to make fewer acquisitions. We're going to reduce our investment a little bit in the core business, but reduce our investment a lot in making acquisitions. The manufacturing picture is a little different. What you see is less drop. And you also see, sort of as you'd expect, a bigger drop from manufacturers in saying in talking about whether they're going to move into a new international market, because as we all know, there are some tax, AKA tariff headwinds in that. So that's the overall picture. I want to go a little bit now to manufacturing specifically in some of this manufacturing study that we did last year. And one of the things that we did, surveyed 400 manufacturers, sort of equally divided between OEMs and not, and asked them what their biggest challenges were, and basically came up with 5 of them, which I will briefly go through for you here. The first challenge is the challenge of intensifying competition, and intensifying and increasingly global competition. The two things are a little different and a little related, and a little bit related. You can see basically 86% of middle market manufacturers say competition is getting more intense. I'm a kind of a disciple of Michael Porter. And if you look at Michael Porter's 5 forces model, in which he looks at the 5 forces that determine industry profitability, the competition between companies in the same industry is only one of the 5 forces. There are other 5 forces. One of them is the power of suppliers, how much, if suppliers have a lot of power, your profits go down. Another is the power of your customers. If they have a lot of power, their profits go down. Barriers to entry, more new entrants, the lower your profits. Substitutions, ability to substitute, I don't know, for Father's Day, I can go to a ball game or I can get a necktie, right? I mean, substitutes also can bring down profitability. It's interesting that companies are seeing and feeling a real intense competition at a time of record corporate profits. Right? It seems like a paradox. Those two things shouldn't compete, but what it sort of suggests is that some of those other 5 forces are not as powerful as they might be. Particularly, I think the labor supply workers have not enjoyed income increases that are comparable to the profit increases of companies. So you suggest that people are saying, competition's really tough, but business isn't so bad, right? You get the same thing. One of the things that's interesting here is you take a look at the role of global in competition and for the middle market manufacturer as a whole, and then you take a look at the role of at the fastest growing middle market manufacturers. And what you see here is that the expansion into adjacent industries is something that the fastest growing companies feel more intensely. I don't know whether they're victims or perpetrators in the expansion into adjacent industries, but these companies, the ones that are growing the most, yeah, they're concerned about global competition, but their number one concern is this blurring of industry boundaries as they move into other people's space or as other people move into their space. It suggests to me not that they've mastered global competition, but that they have stronger capabilities in dealing with global competition. They're doing it better than some of the other guys, and what they're really concerned about is their neighbors encroaching into their space or how they can successfully encroach into their neighbor's space as industry boundaries blur. I'll talk a little bit more about some of those industry boundaries blurring as we get further into this. Now, this survey was taken in March of 2018, and as you just remembered, the tariffs and that sort of stuff started happening right after that. So tariffs did not show up in these data. Subsequent data that we've got show the impact of tariffs, and this is all industries here, from wholesale trade down to financial services. You know, we talk a lot about the impact of tariffs on manufacturing, but not surprisingly, the guys who get hit the most by this are the people in wholesale trade, because they get hit coming and going. It's also interesting, of course, retailers get hit from the cost of importing, you know, knickknacks or whatever it is they're selling from other markets. Construction companies get hit. The cost of steel or the cost of other materials for construction get hit. Manufacturers, some of them get helped and some of them get hurt. On balance, the impact is negative, but there's some manufacturers who are being protected and, by these tariffs who are finding this is not so bad. So some of you in this room might be red and some of you might be blue in that sense. So there's the one impact is the overall impact on how well you're doing business, your profitability, your cost of materials, and what you are going to do with it. We see on the left-hand side here some of the financial impact on margins, impact on costs, impact on prices. The lesson from the left-hand side of this slide is, as much as possible, people do believe that they can pass the cost of tariffs on in the form of higher prices. They're pretty much confident that they're going to be able to hold their margins. I mean, it's sort of divided, but that they are going to pass this cost on. The real story to me, because tariffs will eventually, in 2 years, 5 years, whenever it is, go down to something normal or disappear, let's hope, but at least get to something predictable and manageable. The real impact is the impact on business relationships. Will you maintain the suppliers that you have? Will you maintain the customers that you have? If you are going to leave them, will you ever come back? And what happens as people try to adjust to this. The New York Times carried a really interesting story 2 or 3 months ago about a company in Oregon. I think it's in the clothing business, but I cannot remember. It's a company with sales of about $700, $800 million a year. So middle market, but substantial. They've got 5 people in that company who do nothing but try to figure out how to source stuff through low tariff environments all the time. Completely unvalue-added work, right, caused by tariffs. And all they're doing is trying to say, gee, if we get this in Bangladesh, would it be better? Or maybe Pakistan, or maybe Laos, or maybe whatever it is they're trying to work around this changing environment. We see it in all kinds of other things. I was talking to one of the faculty members that we have in the School of Agriculture who was talking about the impact of tariffs on soybean producers and whether that business will ever come back. I mean, just to draw a macroeconomic or a global underscoring about how awful this crap is. I mean, so Chinese buyers of soybeans to feed their appetite for pork, which is increasing as they get more prosperous, they are no longer buying soybeans from the United States. Instead, they're buying soybeans from Brazil, which is burning down the Amazon in order to plant more soybeans so that the Chinese can change their source of supply for soybeans. Are they going to reforest the Amazon after soybean tariffs go, or after this trade war ends? I hammy doots on it, but this is the sort of impact in global supply chains that may be permanent and may not be recoverable. So it's not to say that the world is coming to an end, although it might be, but it is to say that some of these relationships will never come back. New relationships, they may be equally good, they may be better, will be formed, but there's a lot of hazarai that is going to be going on as people rebuild their supply chain relationships, which sort of leads to challenge number two. Challenge number one is increasing competition, including global competition. Challenge number two is increasingly complex, more demanding supply chain relationships. Basically, across the middle market, people say that upstream and downstream supply chain relationships are getting more collaborative, it's less simply RFPs based on pricing, more negotiation, more intense sharing of information, and suppliers and customers becoming more valuable to one another. Speed, inventory policies, transparency have all driven increased integration across supply chains, and technology has done the same thing as well. This is, again, on the left-hand side, you see all middle market manufacturers. On the right-hand side, you see those that are growing 10% a year, the fastest growing middle market manufacturers. The first thing to see is that customers and that manufacturers are being asked for and are asking for faster cycle times and more responsiveness from their suppliers. So it's, you all feel this. The people you're selling to are telling you this. The people you are buying from are people you are telling this. So we want faster cycle times. We want more collaboration. Our customers want faster cycle times. They want more collaboration. The good news is that the digitization or the digital transformation of supply chains is both a cause and a cure for these things. As supply chains become more digital, as the information flow and the material flow become one flow of bits and bytes and atoms and molecules as they move across, those digital tools are becoming something that can solve or satiate that demand for greater speed at the same time that it causes a demand for greater speed. So digital is an important thing. Challenge number three is changing the mix. And this is part of where you get into the blurring of industry boundaries that I talked about. One of the big trends in manufacturing is the addition of value-added services. So I'm not only going to sell you the product, I'm going to service the product. I may put on sensors so that I can do predictive maintenance on the product. I'm going to install the product. You can see all kinds of ways in which manufacturers are moving into the service end of the value chain. It's driven by a lot of things. Partly it's the fact that, by the way, you're now got a website, and your customers can get on the website. If I want a new part for a Cuisinart, I no longer have to go to the hardware store and have them order it. I can go online and it'll come to me. So you move, so digital opens up the end user to you, but a lot more addition of value-added services. Now, this does a lot of things to manufacturers. For one thing, it changes the things you measure. I mean, return on assets is a pretty good way to measure a manufacturing plant. Return on assets is a terrible way to measure results for a service arm. You haven't got any assets, right? Maybe you got a few trucks and cars, but that's not really your asset. You have to think about different measurements. How are you going to reward people? How are you going to decide whether you're doing a good job? It increases your exposures and your liabilities. If you think of it from a risk management point of view, from a what you got to insure point of view, it changes the skill mix of the people that you have, and it creates all kinds of internal complications in terms of how are you going to allocate your resources and what are you going to do. At the same time, what we see is that companies that are doing this are significantly outperforming the companies that are not. So value-added services, big change, big opportunity, and the fastest growing companies are the ones who are seizing it the most. At the same time, you're also seeing, of course, a mix with IoT and the addition of smart products, and the two things are not unrelated. We still see in the middle market, not a lot. This is a year ago. These numbers will have changed, but changed incrementally. But basically what we're seeing is about 22% of the middle market as a whole, 26% of the fastest growing middle market companies say that they have a substantial number of IoT products. But that is rapidly changing. I mean, you think about the ways in which this is affecting. I mean, one of my favorite middle market manufacturers, the Overhead Door Corporation. They started out in Indiana, now moved to Texas, so they've moved to a decreasingly competitive state. But you know, they're garage door openers. They started invented in 1920, something like that. The first and last big technical change in garage door opening was then that was in the mid-20s. Now, of course, a garage door is part of a home security system. Now, and are they the supplier to the home security system? Are they the overall general contractor for the home security? How do they fit into a new, more complicated ecosystem as products get smarter? Just east of the airport in Columbus is one of my favorite middle market companies, a company called Grody. Grody, anybody who's ever eaten a Donato's pizza, it's a Central Ohio pizza chain. If your name is Grody, you want to open a pizza company, you get an Italian name, so they called it Donato's Pizza. And old man Grody back in the late 40s got tired of slicing pepperoni, so he invented a pepperoni slicing machine. The problem is if you got two pizza parlors and you're maybe slicing 3 pepperonis in a day, it's really not an effective use of capital equipment, but he goes into the frozen pizza supply business. Now they're in the big, if you had a French fry at a bar recently, it was probably cut through a Grody food processing equipment. And their business is a razors and blades business. Their business is, we sell you the equipment, but you have to keep the blades sharp so those French fries come out nice and crisp. And they have now realized that they have to put sensors on those blades. Because if they don't put sensors on those blades, somebody else is going to put sensors on those blades, and they're going to be in the razors and blades business, and they'll only be selling razors. So this company is also now working with additive manufacturing to see how additive manufacturing can be done to make pizzas with additive manufacturing. I mean, it's an extraordinary case of what you think is a pretty mundane industry where they're really changing the mix to smart products. And at the same time, by the way, we'll get to the skill question in a minute. Guys who are running the company now say, my biggest problem is getting people with manufacturing skills, and I really need welders. And he says, so when I go to recruit people, he says, I go out to the farm. Because on every farm, there's a kid who doesn't want to work on the farm, but who knows how to do welding. And so he recruits welders to come in. So this is a really interesting company as the mix changes. That's rapid technology change on the factory floor is a similar fourth, and all of these challenges, as you can see, interrelate. They're like logs on a fire. And each one of them makes the other ones burn faster and hotter. So cybersecurity, you now have to be concerned about protecting the safety of your product because you don't want your pacemaker to be hacked or your car to be hacked, but you also have to protect those machines on the floor, which may no longer have air gaps between them and the internet as you start connecting with your suppliers, right? So cybersecurity becomes a much bigger issue for manufacturing than it did. Obviously, new materials and composites, advanced process control. I was at Lyft the other day here out and looking at some of the stuff that they're doing with advanced materials, which is like extraordinary, right? That's at the cutting edge of stuff, but all of you guys are seeing these issues of additive manufacturing, robotics, advanced process controls, embedded sensors, some of the stuff that we were talking about. Cybersecurity is the #1 issue. And it's, of course, it's on the factory floor, it's in all operations, your customer information, your supply chain information, your financial information, your people information. But it's the most extraordinary issue. Advanced processes and new materials and composites are the ones that sort of come in after that in terms of the priorities, in terms of technology. And challenge number 5 is talent, 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 talent. I mean, you can drive up here from Columbus and you pass the billboards that say truck drivers wanted. You know this. You need welders. You need somebody with fundamental vocational skills who can pass a drug test. And above all, you need people who can deal with this cybersecurity, this with value-added services, with an internet-enabled factory floor. So you need not only your basic vocational and technical skills, but you need digital skills. Our friends at Brookings have been tracking the digital skill level required for various jobs, from receptionist to utility repair person to FedEx delivery person to manufacturing person, and the level of the digital skill level across basically all job descriptions has gone way, 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 way up, and only a third of U.S. jobs created since 2010 are available to those with low digital skills. And when you think about, your classic entry level, I went to, majored in shop kind of manufacturing employee, that's a whole new world. It's a whole new world for them. And for those kids, whoever they may be, and it's a whole new world for you as you figure out how to bring them into the business. Overwhelmingly, people say that the impact is positive. It'll increase productivity, it'll increase flexibility, it'll increase profitability. It does increase my capital costs. It does increase my security risks, but the overall impact of technology on manufacturing is positive. There's a whole risk element in this. One of our sponsors is Chubb. They're very concerned with us helping people to understand their risks, and playing a more important role in the supply chain increases your responsibility, and by the way, increases your vulnerability to how responsible they are. The geopolitical climate is increasingly important. Digitization opens new doors, and those are doors of opportunity, but also those are doors to bad actors as well. Adding new services leads to continuing responsibility for your product or your service, and new kinds of warranties and new kinds of liabilities. And IT and operation systems must become more integrated, which increases all kinds of operational technical risk, as well as, of course, the security risk that I mentioned. The best guys are finding the ideal mix of international and domestic, not too international. The middle market manufacturers that we see that are more than 50% international in their sales are not doing as well as others. 25, 30% seems to be the kind of a right number. They find the right mix. They have strong relationship management mindsets, up and down with suppliers and customers, with employees and everybody else. They offer a higher level of value-added services. They're implementing a variety of advanced manufacturing techniques. They're not just going all in on additive manufacturing or all in on robotics. It's one from Group A, two from Group B. They're doing a lot of things to improve the technical sophistication of their manufacturing manufacturing operations. And they're tackling the workforce challenges with a stronger mix of things that they do to project a robust employer brand so that they can attract people, to do more training and development. It's hard for middle market companies. You haven't got the resources in many cases to do a lot of training and development, but these people are also forging stronger relationships with community colleges and others. One of my favorite examples of this is a company outside of Albany called the Simmons Machine Tool Company. Middle market company. They've been around for about 80, 90 years. They were the first US company to make an acquisition in what was former East Germany. One of the things that they make is a sensor that tells you whether railroad rails are parallel, which is an important thing for them to be. And if you can do that electronically, it's really nice in North Dakota in the winter, because you don't have to send people out there with tape measures over the icy Great Northern Railroad. But one of the things that they do, nobody's heard of Simmons Machine Tool, right? But they're near Rensselaer Polytech. They're in the Albany, Utica area, and every summer, on the nice day in that part of the world, they have a fair where they bring in, guess what? Old cars. They bring in 57 Chevys. They bring in Corvettes. They bring in Edsels. Whatever. They just put it. They fill their parking lot with cars, and then all the kids who are really interested in cars show up and they're playing around. They say, "Hey, you want to come inside and see what we do?" It's a really interesting example of a company that is using its mind. They also have a strong relationship with Utica Community College and a few other things, but it's a really interesting example of a company that is saying, we want to attract a certain kind of people. We need to project an employer brand. Oh, wow, you guys do cool stuff. I've never heard of you, to a kind of talent pool that they might not otherwise be able to reach. Compare and contrast that to a fintech company I heard about in Atlanta. HR person says, I need people who have computer science degrees from Stanford. I can't get them. She says, they all go to Google. Google has a big presence in them. They all go to Google, they go to Amazon. Says, but I do track them. And I follow them on LinkedIn or wherever I can. And when they have kids, I pounce. This is because foosball at midnight seems a lot less attractive when you got a kid with a mobile. So it's really interesting. You need to, whether it's welders on farms or kids poking around in the carburetors of old cars, or whether it's people who are tired of playing foosball at midnight, that talent issue is one that you're going to have to solve in creative and imaginative ways. We still have a full employment economy. That's good news, except when you're trying to grow at 10% or more a year. So with that, we've got a couple of minutes for questions, and thank you very much.
We have a couple minutes. Any questions for Thomas? Obviously, some great data, and that lines up when you talk about when we did our presentation a few years ago on attracting and retaining talent, and it's about the brand that you portray.
Yeah.
Right? And a lot of our middle market don't even think about that, right? And it's so critical today that you have to brand yourself to find talent. Any questions?
Yeah. Well, to what extent can tariffs cause an increase in the cost of other products and services like haircuts? Yeah, it can cause inflation. I mean, first of all, it is a tax, right? It is a cost increase, and that is inflationary unless you can take it out of other things. There are certain responses that, I'm not going to predict on this. One of the things we saw here is that people said they're going to try to pass it on. There's another thing that you see is that people are trying to sort of say, what can we do to get around those tariffs? I mentioned that company in Oregon, but also around Columbus, L Brands is not exactly a stock you wish you owned right now. But one of the things that Limited did is they created something called Beauty Park, and they asked all their main suppliers to come and locate near Columbus so that they could have more high quality sharing of ideas, but also so that the pump on your hand sanitizer now makes a journey of 12 miles instead of 12,000 miles. So, tariffs have knock-on effects in all kinds of things, though. It affects the ingredients, the materials in your car. It affects the construction costs. It can affect all kinds of things. It will increase costs unless people can find other ways to take the costs out.
That's what we've been doing.
Yeah.
Wringing out those costs.
Yeah. But or unless you can innovate, as you were saying, innovate your way around it, right?
Innovate your way around it.
And if more of your revenue mix comes from services, for example, that may be a way that you can increase your revenues and eat those costs and not pass them on.
You don't have to worry about them anymore.
Yeah.
So that's it's a good lead into really we're going to take a break, but it's a good lead in, for our next sessions, really on our industry, or we'll start off with Plex and really kind of get back into that innovation and you know, that digital product, just what you were talking about, right? It's just becoming more and more relevant.
One other question here if we've got time.
Yeah.
Yeah.
I'm just curious, in your data set, are there any industries, you didn't talk about specific industries in here, but are there specific industries that are doing better in the middle market than others?
Yeah, I mean, I mentioned that construction's been a real star. Healthcare has been very strong. The last 6 months has been a little not as strong, but I mean, manufacturing's been right solid in the middle. We look at 7 plus other. So there's business services, healthcare, construction, financial services, manufacturing, retail, wholesale, other. The strongest performers over the last period have been business services, which includes a lot of IT services. We're also now carving out technology, which is a mix of manufacturing and services. That's very strong. Manufacturing has been right solid in the middle. Retail has been struggling. Wholesale has been struggling. I think some of that margin question in wholesale, but basically everybody's been doing really well. But I've been really surprised by the strength of manufacturing.
Well, from the manufacturing front, like we see, like, do you track much like aerospace and defense versus autos versus industrials, or?
I can't get down to that. I can't get down to that level of granularity, unfortunately. Yeah. Yeah.
Yeah. But I know you're going with that also.
Yeah.
Well, we're going to take a 15-minute break, and then we'll be back in 15 minutes for we'll get our next presentation going. Thank you.
Okay. There's that. All right, if everyone could take their seat, we're going to get started. Nobody cares. Nobody wants to listen to me. All right, great conversation. Awesome, thank you. If everybody could take their seat. Thank you. Okay. Please take your seats. Thank you. Thank you. Our next presenters are from Plex. Many of you probably have heard of their ERP systems, and some of you may be using their ERP systems in your manufacturing company. But what intrigued me about Plex always is there is a certain level of innovation that they have been kind of one step ahead, I think, on some of the competition. When we talk about Internet of Things, connected devices, smart manufacturing. And so pretty excited to have them here today. Talk a little bit about Industry 4.0. Obviously, Thomas Stewart talked about that move into the next phase there of disruptive and digital manufacturing and digital products and smart products. So this is our step. These next three presentations that we have are really focused on innovation and the process to get there. So I want to welcome Anurag Garg. He's VP Product Analytics and IoT at Plex, and Jerry Foster, Chief Technology Officer at Plex Systems. Thank you.
Thank you, Tom. So good morning, everyone. It's great to be here. I'm Jerry Foster, the Chief Technology Officer at Plex, and my colleague Anurag Garg is the VP of Analytics and IoT at Plex. Tom already said that we do ERP software. Sometimes when I speak to people that I haven't spoken to before who might not know Plex, I always start off by saying, Plex Systems, we make hair growth tonic. And everybody's like, it's not working. Does he know it's not working? Or maybe it's the before and after. That's what but we make ERP software, MES software, born here in Detroit area, hardcore manufacturing. Our customers are hardcore manufacturers. And so I've been involved in manufacturing basically my whole career. So why are we here today? We're here to talk about Industry 4.0. As if we haven't talked about it enough, right? Everyone wants to talk about Industry 4.0 and manufacturing and technology, and sometimes they think, man, we talk about this a lot. Are we tired of talking about Industry 4.0? Like, I guess not, because here we are, right? And the question that was posed for us for this forum was, how can we use technology to compete? How can our customers use technology to compete? And I think back a long time ago when I first started, I was a programmer at a forging company. And we had just replaced our character-based ERP system, like with a dumb terminal character-based system, with a brand new, honking, brand new Windows GUI formed, beautiful color system, late 90s. And we put this out in the plant, and I was told, okay, Jerry, I need you to go out there on the shop floor and help these guys and gals learn how to use the new system. I'm like, no problem, this is awesome. Why? This is so easy. So I ran out there, and I ran into the foreman shack, and Chet was standing there, and he was looking at the computer, and he had a look on his face. And I'm like, Chet, what's going on? I'm trying to add a gauge. I can't add a gauge. That's easy, Chet. It's right there. It's this button right here. Just press that button. And so he went to the keyboard and he started using the function keys and the arrow keys, like with the old system, to try to press that button. I said, no, Chet, no, you just use the mouse to press the button. So he picked up the mouse and put it on the screen and tried to push the button. So when I think of pushing and prodding and pulling the companies that we serve into new technologies, it's a very holistic way of thinking, right? It's not just the technology, it's not just the machines and devices, it's the people, it's the process, it's everything, and that's what we have to do. So today I'm going to be talking more about, we're going to kind of do a dual session, and I'll be talking about the trends in technology that I'm seeing and that we're seeing, and looking at things from more of a holistic view. What is Industry 4.0 and why are we here and how did we get here? Then Anurag's going to take you kind of under the surface and talk more about some specifics and some use cases and give you some tips and pointers that you can use and that your customers can use as we talk about Industry 4.0. So I'm sure you've all heard about the industrial revolutions. These pictures right here are very familiar to you. The first 3 industrial revolutions, I'm sure you all are familiar with this. When you think back to high school or junior high and the 3 industrial revolutions that were in your textbook, although looking at some of you, there might have only been 2 at the time that you were looking and studying this, right? But the 3 industrial revolutions, the first one, of course, had to do with steam, when we went from hand-making parts to actually using machines. And then the second industrial revolution, the advent of electricity and rapid industrialization, culminating in production lines. Then, of course, the third industrial revolution, where we actually started to automate and computerize all these processes. But now all those textbooks are going to have to be rewritten because we are now in the 4th industrial revolution, sometimes called the cyber-physical revolution. Why is that? Why is it called cyber-physical? That word cyber, I think of like Terminator, right? The word cyber-physical, what that has to do with is actually we are having virtual representations of physical entities. That's what it means, virtual and physical. You probably have heard of the term digital twin. But when I think of the 4th Industrial Revolution, I just call it connected manufacturing. That's what it means to me. Connecting people and machines and products with algorithms and software and technology. Just connecting those things and seeing what happens when you get the physical and you superimpose on top of that the virtual. And we call that digital twin. Do you guys remember the first time you actually saw a digital twin? Remember, a digital twin is just a fancy word for taking something that's physical and then having a digital or a virtual representation of that. I remember the first time I saw a digital twin, it was 1977. Do you remember what happened in 1977? It's going to happen again in 2 months. Yes, fellow nerd back there, Star Wars, right? That's a digital twin right there. That is a virtual representation of something physical. And Luke Skywalker saw that, he was like, oh, she's beautiful. And I saw that, I'm like, oh, that technology is awesome, right? In my defense, I was only 10 at the time. But we're living in Star Wars right now. That's what we're doing. We have virtual representations and digital representations of physical systems. So then what is Industry 4.0? To me, Industry 4.0 is kind of like a subset of the 4th Industrial, get some feedback, kind of a subset of the 4th Industrial Revolution. And it has to do with manufacturing, with making things. And I probably would not include things like connected homes and smart cities in Industry 4.0. It has to do with people who make stuff. Manufacturers make stuff. They're very tangible people. Here in the Midwest, we call them salt of the earth people, right? They love that tangible feeling, that tactile feeling, because they make things. I remember the first time we actually tried to sell a cloud-based system to a manufacturing executive in the early 2000s. And we were telling him all the benefits, and he stood there and got all perplexed, and he started yelling. He was like, where's the software? Where's my server? Where's the software? I want the software. Actually, what he said was a lot longer than that, but after you took out all the swear words, that was kind of all it was. But how do we help this manufacturing executive? How do we help people like him in manufacturing on our shop floors? It's with Industry 4.0. But why should we care? Why should we care about that manufacturing executive? Why should we care about digitizing, about digital twins, about Industry 4.0? Why should we care? When I ask myself that question, why should we care, I think of one person. His name is Richard McDermott. Richard McDermott is an immigrant, self-made man. He came over here from Europe with nothing. And he would buy plants and factories in Detroit that were decrepit and abandoned and in awful condition. And he, through sheer force of will and intellect, his mechanical skill, he would rebuild those plants, rebuild those presses, and get those things working and starting making parts. And I had the privilege of working in the computer department for one of his forging companies. I was a programmer. And we were doing some really cool things we were making. This is back in the 90s. early 2000s, we were making MES systems, ERP systems. We were connecting CNC machines, connecting gauges. We were doing all sorts of cool stuff. And one day I was out working by one of the presses, and Richard came in. He was coming out to talk to me. I could tell he had something to say, and he was focused. He was looking right at me, and I thought for sure he was going to say, Jerry, thank you for being an awesome programmer. Your skills are unparalleled amongst all the legions of developers the world over. And I was waiting for that, and that's not what he said. This is what he said. He said, Jerry, I don't care what you do, but you better not bring that press down. If it's not going up and down, if we're not making parts, we'll go out of business. Okay, I remember that, right? But when I was reminiscing on that, I thought to myself, this is why we do this. This is why we talk about technology. This is why we talk about Industry 4.0, is to help Richard make his parts better. So instead of worrying that the technology that we're going to put in place is going to bring his press down, we can now use that technology to actually determine and predict when it's going to go down and why it's going to go down and what are the factors involved in why that press is going down, and then use all that to actually eliminate that downtime altogether. How cool is that? That's why we do this, right? And that's why we get excited. That's why I get excited, and that's why I love doing this. So what are these technologies that can help people like Richard? So when we talk about Industry 4.0, there's usually about anywhere from 10 to 15 different technologies that are involved, depending on who you talk to, and I've got some of them up here that I think are involved in Industry 4.0. But here's the problem. We need a way to talk about all these holistically, right? All these together. So we give it this moniker like Industry 4.0. And when we do that, it has this perception of being something huge and big. It's a revolution, right? And how do you get involved in a revolution? It's Industry 4.0, and you're like, I feel like I'm still in Industry 2.3. How do I get up to Industry 4.0? How do I get there? And so one of the problems with using terms like a revolution is it kind of puts an artificial barrier, even psychologically, on getting there and getting our customers and moving them along. But here's the thing, you guys. Most of these technologies have been around for a long time in one form or another. And so instead of being like a great big bang, like Industry 4.0, just bam, it was here, it's been gradual. It's been a continuum, like a timeline. So there's been trends and spurts, maybe spits, I don't know, spurts and ups and downs and trends, right? And so that helps me kind of conceptualize what we need to do to help move our customers to Industry 4.0. In fact, this is the IBM 709. This was a computer built by IBM for the express purpose of creating a central computer that could be given to universities and then split up compute power and share that compute power against multiple users. This was given to MIT in 1963. So 60 years ago, we had a central computer that was divvying up compute power for its users, very similar to what we have now in the cloud. Or take big data, for example. We went from kilobytes to, what's next? On and on and on. That's in my mind. But we didn't. The point is, we didn't go from kilobytes to petabytes or zettabytes, wherever we're at right now. We didn't just jump there. It was gradual. Right? It was once more and more data, and there might have been like a hockey stick slant to that graph. But somewhere along the line, someone was like, well, that there looks like some big data. And then the name stuck, right? Big data. But just because that person called it at that time doesn't mean that's just when it happened. It's been a gradual thing. So these technologies have been around for a while. So if most of these technologies have been here for a while, why do we have Industry 4.0 now? Why is it a thing now? It's a thing now because of the convergence of three things: cloud, data, and compute. We now have a platform, the cloud, on which we can store a ton of data cheaply and then apply to that data and analyze that data with almost unlimited computing power, also cheap. And the cool thing about this is that it levels the playing field. It allows anybody to get in on the act. It's no longer the purveyance of all these huge corporations who can afford all the infrastructure. Even now, a mom and pop operation can be participants in Industry 4.0 because of this right here, the convergence of these three things. And that's the cool thing about this industrial revolution. It democratizes these technologies. So all those technologies we showed on the previous slide, they are now accessible and available to just about everyone, and we can all start to participate, which is good news for all of us. And we can take these technologies, we can start mixing and matching which ones will apply to us. And the cool thing about this is when we do that, we often end up with something that is bigger than just the sum of its parts. You're like, okay, Jerry, how is it? How is this bigger than the sum of its parts? So we'll illustrate maybe with an example that's really concrete for manufacturers, and it's something I've already mentioned, that's downtime. So let's say you have a shop floor system that's measuring your downtime. It could be any system. It could be a manual system. It could be an MES system. Maybe it's spreadsheets. You're using spreadsheets to capture the downtime. And so after every shift, you create a new spreadsheet to record all the downtime information. And you've been doing this for a number of years, let's say 5 years. Then the CEO says, you know what? We've been collecting all this downtime information for 5 years. I want to know something about that. I want to get some insight from all this information we've been collecting. So what's he supposed to do? He's like, okay, I got all this data. What do I do with it? How do I analyze this? He could hire an intern. Okay, all right, Mr. Intern, I want you to start looking at these spreadsheets. Well, if I did one spreadsheet per shift for 5 years, that's 5,400 spreadsheets. This guy over here is 365 times 5. It is, all right? How do you have one intern look at 5,000, 6,000 spreadsheets? Well, I'll hire more interns. We'll get 4 or 5 interns in here. Okay, well, you divvy up the work, and they're all analyzing different spreadsheets. But then how do you bring that all back together holistically with one set of analysis for all of them? Okay, well, maybe I'll ask them to write a program. Okay, they'll write a program to analyze this. And a program is basically a bunch of if-then statements. If these conditions, then this is what happened, which means I'm actually starting to put some bias from my experiences into the analysis. You guys, this is what the cloud and data compute convergence gives you. It gives you 100,000 interns. It gives you 1 million interns all working together like some great big simulated board from Star Trek. This is what you get when you go to the cloud, 100,000 interns. And this is why we can now start to analyze and utilize all of this data and participate in all these technologies, because we have 1 million interns at our disposal. And it allows us to get involved at a scale that is appropriate just for our needs. So I think some companies, and some of the companies that we deal with on a day-to-day basis, they look at Industry 4.0 and they look at all these technologies and they're like, how do I get involved? It seems so big and it's kind of loosely defined. How do I get started? And this is the good thing when you recognize that most of these technologies have been around for a while, right? And that you also have a level playing field and you have a platform and a capability to get involved at a scale that suits you, you can define your own Industry 4.0 transition. You can start building a transition path that works for you. And you don't have to worry. You don't have to jump over the cliff into this great big Industry 4.0 chasm. You just start working at a pace and a position that's appropriate for you. And so how is that? How do you do that? Well, one of the first things that you have to do is look at the physical systems that are happening in your company or in the companies that you serve. What is actually happening on the shop floor? Map out those processes. Map out the physical executions that's happening on the shop floor, that's happening in accounting, that's happening in the front office. What are all those physical systems? Because those are actually happening right now. And you map all those out on the factory floor. Then you can say, okay, I've got these 10 or 15 technologies. Which ones can I cherry pick and put on top of these physical processes that are already happening? So then, jumping onto this Industry 4.0 is more like a merge. It's more like an on-ramp instead of a blind leap into a huge valley or into a huge chasm. And that allows our customers, when we talk about it in this fashion, it allows them to kind of conceptualize better how I can get involved, how I can start this process, and it's not so overwhelming. And that's the key. We want it to be not overwhelming. Now, it does require 2 things. Obviously, you have to know a little bit about your business, and you have to have a kind of a surface knowledge of the technologies involved so you know what to apply where, but it's not too difficult. But once you have those, you can be off and running. And it's important that we think about this in terms of one thing, or 2 words, business value, or value drivers. Have you ever had someone, you read an article, and they said, you need an IoT strategy. You have to have an IoT strategy. And you're like, okay, I need an IoT strategy. I don't have an IoT. Do you have an IoT strategy? I don't have an IoT strategy. And you're like, I don't know what to do. All right? It's not your job to implement an IoT strategy. It's not our job to implement an IoT strategy. It's our job to improve the business. And that's a key differentiator. We need to increase quality, increase efficiency, reduce scrap, increase the safety. That's our job. The technology is just a tool. It's just a mechanism to do that, right? You ever had someone go on a trip and they're like, oh, it was all about the journey. It was a beautiful journey. Not in business. It's not about the journey at all. It's about the end game. It's about the ROI. It's about those value drivers. I love this chart here because what McKinsey did with this chart is they went to a number of companies that had implemented some Industrial 4.0 technologies, and they wrapped them in terms of value drivers. It might be hard for you to read here, but there's 8 of them here. And we're not going to go through all of them. Things like time to market and labor and assets. And then they took some metrics that they had accumulated from those companies and they associated those and matched those up with those value drivers. And this is important for two things. In fact, and you can read this, I think the slides will be available. For instance, this mining company, they utilize autonomous vehicles, and they reduce their fleet costs by over 10%. That's the kind of thing that's important. That's how we look at this, and that's how we think about this. And it's important for two reasons. The first one is if you're a technologist like me, you have a desire and a propensity to just implement technology for technology's sake because it's cool, right? I got home a couple days ago, and you know what was sitting on my porch? A box from Amazon. I get all excited, right? And I go to this bed, and I open up the box, and it was a brand new pair of Bluetooth earbuds. I didn't need a brand new pair of Bluetooth earbuds. These just wanted more colors and more lights, right? But I didn't need them. But you can't use that justification when you are in business. You have to put the brakes on and say, what is the value driver? I can't implement this technology just for technology's sake. The second reason it's important to look at it in this way is that it'll help you gain acceptance, approval, and budget when you want to start to implement these things inside of your factory, inside of your plant. You can't just run into the CEO's office and say, hey, we should get an OPC network, and we should start hooking up all these machines and put all these graphs and charts all over the plant. And he says, why? And you're like, that's a dumb question, because it's cool. That's why, because it's new. He's going to shake his head. Instead, if you were to go into his or her office and you said, you know what, I did some research, and companies that are in our industry, at our size, when they start connecting some machines and start utilizing IoT, they reduce scrap by 10 to 12%. Now you're talking. Now you've got the ear of the people who are involved or important and can make these decisions. So remember this. It's so important that we always think in terms of business value. So, what are some of the trends that I see from just my perspective with all the companies and manufacturers that I work with? What are some of the trends that I see that are going on in the industry right now with technology? And the previous slide had 10 to 15 different technologies up there. But if I was going to narrow it down to about 4 of them, these are the 4 that I see that are really making an impact for our customers right now. The first one is automation and robotics. Right? The advancements in robotics right now, and collaborative robots, is off the charts. The capabilities, the intelligence, it's amazing what is happening now in the area of robotics. And of course, this has been going on for some time, and it just keeps going on exponentially. One of the things that I used to hear this quite a bit was, Jerry, what about the robots? They're going to take all our jobs. They're going to take all our jobs, like Terminator, and then they're going to kill us, and then it's going to be over. But you've already heard a couple of the previous speakers talk about the shortage of skilled labor in manufacturing. So from my perspective, from my opinion, we don't have anything to worry about robots taking our jobs in the next few years. Because for the foreseeable future, all they're going to be doing is replacing vacant and open jobs that we have right now. So right now, as far as I can see, this is just going to help that situation, not make it worse, at least for the foreseeable future. Connecting more things. This is a Jerry Foster technical term for IoT. We're just going to connect more things. When I go to the shop floor for our customers, everything that they are getting on the shop floor, everything from the tools to the torque wrenches to the machines to the presses, they're all IP enabled. Everything's being connected. And that's just going to happen more and more and more. And we have some customers that are now putting out some really cool technology to help connect some of the older machines and presses that have been around. So some of our customers have World War II era presses that are running in their factories. How do you connect those things? Well, there's now solutions out there and capabilities that you can start to connect those things. So now that we're collecting all this data, what do we do with it? And that leads me to the third trend, and this is leveraging that data. Basically, this is machine learning. Machine learning is having a huge impact right now. Machine learning is all over the place, and you can leverage this data. In fact, one of the interesting things about machine learning and artificial intelligence is that it is actually a technology enabler. In other words, it actually is one of those few technologies that you can actually apply to other technologies and make them bigger. For instance, IoT. You connect some machines out on the shop floor, and you're starting to get some really cool data off of those machines, and that's useful. That's useful data. IoT is great. You're getting cool stuff. But if you apply machine learning and artificial intelligence to that, and you start to get some insights from that you never knew before, now you've taken that IoT capability and you've elevated the value exponentially by applying machine learning to it. And that's why machine learning is so huge right now. In fact, Google right now, when Google has a problem that they want to solve, their first direction, the first thing they do is apply machine learning to it. It's just a matter of course now for everything that they do is how do we solve this with machine learning? It's the technology that they are using. And what's the fourth one? Additive manufacturing or 3D printing. This is amazing what is happening in the area of 3D printing. You can now you can now actually print metal parts that are actually strong enough and in spec and work actually in production environments. In fact, the GE LEAP engine, which is in use in the Airbus 320 and the Boeing 737, it has 19 fuel nozzles that are printed. Think about that for a minute. I mean, what's the future hold there, right? You see, you're in the Delta tool room. You go, all right, this engine failed. Okay, I'm printing a new one. We're printing parts that are in our airplane engines. That is fascinating. We never could have done that before. And what's happening there is now we're cutting out all the middleman costs in that. And the other cool thing with that is that we're taking the middleman out of that process, and you know what we're putting in its place? The consumer, the customer. Because we can now take the consumer and put them right in the middle of that process and personalize the manufacturing, because the cost to go from one print to the next is negligible, so I can change it as needed. Fascinating stuff here happening in the world of additive manufacturing. So those are the 4 things that I see. You might have a different list. Some other speakers might have a different list. But from our perspective and the customers that we're working with, this is the stuff that's really making an impact in their environments right now. So John Hitch, who's a writer for Industry Week, he said this. He said, maybe the problem with all this new technology emerging on the scene is that there's too much data, there's too many decisions to make, too many vendors to choose from, and too many case studies to read, and there's never enough time, right? So hopefully I've given you some frameworks to actually think about how to approach this problem, and then I'm going to hand it over to Anurag, who's actually going to maybe go a little bit deeper and help you talk about this even more. Thanks, Anurag.
Thanks, Jerry. So Jerry spent some time talking about technology trends, what's happening in the industry, what we should be aware of. What I want to do now is shift the conversation a little bit away from technology trends to how do you actually use these technologies to drive success? This is a question that gets asked of me and of us at Plex a lot. Technology is great. How do I actually use it, right? How do I separate all this noise of vendors and case studies and use cases and what seems like a new company that pops up in the space every week? And how do we drive focus and successful business transformation, right? And if I can draw from something Jerry said, the question is not what technology do I use or how do I adopt technology? The question is what business problem am I looking to solve? Because if you start to think that way, if you start to think about the business problem first and the transformation you're driving, we can break this down and really think about, okay, what's the change management process, right? Technology, people, process, kind of just going back to the basics. What I want to do for the rest of this presentation is to help you walk away with a framework for when you're applying new technologies to your business, especially in the industry where change is not really, nobody looks forward to change. The manufacturing industry is usually resistant to change. We've been doing the same thing, same way for 20, 30, 40 years. How do you drive change in this space? And hopefully this process of technology, people, process gives you a framework. And I'm going to walk you through a few case studies of what happens when this works and a few case studies of what happens when this doesn't work. Lots of stories in here from experience to walk through. So let's dive right into it. Starting with technology. Jerry's talked about this a lot already, so I'll speed past this one. The manufacturing floor is complex. Lots of things happening, lots of problems to solve, accurately recording production, improving quality, tracking supply chain, visibility, behaviors, lots of things to do and lots of technologies to pick from. What you want to do is to start small. The entrepreneur in me, I'm an entrepreneur, I'm a product leader, I'm an engineer by training, and you'll see that come through in this presentation. The entrepreneur in me says, pick one problem, start small, iterate, fail fast, right? By picking one problem at a time, you're able to focus your efforts, focus technology selection on what will drive the maximum impact for the business. Technology is a tool in the process of transformation. It's not the solution itself, right? Right. And if you do this one problem at a time over and over and over again, you'll eventually get to a point where you'll have a sophisticated enough system that is taking into account all the different parts. Plex started doing this 25 years ago, solving the quality problem first. And where we have come to now as our more mature customers, are now solving more and more complex problems, having solved one problem at a time and looking at entire systems, shop floor to top floor, supply chain to customer. Right? Taking an example from an industry we're very familiar, level 4 autonomous vehicles. Right? This conversation of self-driving cars did not start 3, 4, 5 years ago. It didn't start 10 years ago. The path to level 4 autonomous vehicles started decades ago. And many of us don't realize this. The automotive industry has been solving one small problem at a time. It started with proximity sensors and cruise control and collision avoidance systems and adaptive cruise control and driver assistance features. And one by one, now we're at a point where cars can navigate themselves through roads and you can keep your hands off the wheel. But Tesla's still saying, don't fall asleep. Right? We're not quite there yet. But it always starts with one problem at a time. So on the technology front, pick technologies that help you solve a critical business problem and go after it one problem at a time, learn from what it took to bring in a new technology, develop the right habits, and iterate through solving the next problem and the next problem and the next problem. Right? Number 2, the people. So as a product leader, it always starts with who's your customer, who's your audience, right? In this case, when you're driving manufacturing transformation, when you're looking at how do I solve business problems, how do I bring new technology in, how do I drive change, your customer, in this case, is the people on the shop floor who are using it. And the truth of the matter is, the audience is changing. 40% of the manufacturing workforce in the US will retire in the next 10 years. So not only are we dealing with digital skills in the existing workforce, we're also dealing with what will the workforce of the future look like. There's 2.2 million jobs that are about to go unfulfilled over the next 10 years. Right? So how do we help address that problem? How do we help fill those jobs? How do we bring in the next generation of the manufacturing workforce? How do we attract millennials? And the problem is millennials don't like to work in manufacturing. It's not a sexy industry. For the most part, it's archaic, right? And there's multiple problems out there why millennials don't want to work in manufacturing. But one of them is the manufacturing environment doesn't do enough to cater to the existing needs, habits, and behaviors of the millennial workforce. The average millennial uses data, uses technology, uses their phone for everything, makes data-driven decisions. Think about the average manufacturing floor. Not enough data, software systems that look like they were built 20 years ago, and the idea that there's an app for that doesn't exist in manufacturing, right? So put technology and people together. When you're going through selecting technologies, think about the needs of the people. Think about technologies, systems, platforms. I did not realize the slide had to build. Think about technologies that will address the needs of not only the existing workforce, but the evolving workforce, the evolving customer. I genuinely think the challenge to adoption the challenges to adoption of industrial IoT and Industry 4.0 technologies is not the fact that the technology doesn't exist. It's not the fact that the use cases or the case study, the success story doesn't exist. It's not that the ROI doesn't exist. All of that exists, and it has for a while. The challenge is the habits don't exist. The behaviors don't exist on manufacturing floors. And I've got a case study, a great case study to illustrate this in a second, which I'll get to after my next slide. But the average manufacturing worker is not used to looking at data on a daily basis, does not have the habits to pull out a phone on the manufacturing floor and look at what's happening on the machine, does not have the habit of starting their day making data-driven decisions. The average manufacturing worker is reactive to what is happening on the shop floor. If we want to drive transformation, we have to build new habits, which brings me to point number 3, process. Process is not about, in this case, process is not about what's your deployment process, or is not about what's your implementation process. It's about how do you build the right habits? How do you ensure the technology you bring in will get used, will create new habits, and those habits will be sustained over time? Because until you have that cyclic loop of new habit generation and sustaining those habits, you don't have transformation. Right? So take technology, people, process, and put that together. This is the case study I really wanted to get to. This is a customer we worked with several years ago. I won't name the company. This is a top 10 automotive parts supplier globally. Massive company, massive budgets, big interest in IoT, technology transformation. And they came to us with the problem. They had a critical piece of equipment on a R&D facility, air handling equipment, that if this went down, it took down a fourth of the facility. 4 air handling systems and an R&D test facility. If this went down, 1/4 of the facility was gone, right? It was unsafe to work. And they were reacting to maintenance events. They called on us. We put some sensors on, started collecting data. This was the startup that I ran prior to coming to Plex. This was one of our early customers. Very, very simple use case. Pick one problem, look at temperature and vibration on this air handling system. Early indicators of failure, right? 2 weeks after installation, the system started doing something funny. Vibration started acting strange, temperature's doing something strange. Early customer, we're looking at the data with them. We call them up and say, hey, Scott, something's going on. No response. Get his voicemail. The system's generating email notifications. No response. 2 weeks later, these lines go flat. Vibration goes down to 0. Temperature goes down to ambient. At some point, we get a call from Scott. Hey, Scott, what happened? We saw smoke from the air handler, so we shut it down. Wait a second. The system generated alerts. We called you guys. Yeah, our users don't look at the data on data usually, and when those alerts came up, they didn't trust the data. So here is, you have the technology, you have the use case, you have someone in the facility who's bought into the idea of, this can impact us, but the users using the things did not have the habits, did not trust the data. So it's not about the technology, it's about the habits, the people, and the process, right? This is a great statement that I abide by a lot. It's, when performance is measured, performance improves. If I tell you I'm going to measure you on something, you will work harder to improve it. But when performance is measured and the results are reported back, the rate of improvement accelerates. So if I give you the data on how you are doing on a daily basis, what that does is it empowers you to make decisions to improve cyclically. It brings you into the process. It's no longer a top-down, I'm measuring you, you do a good job for me. It is, you're now empowered to improve yourself. When you do that across the facility, when you do that across, down to the machine operator, you have the cyclic process of building the right habits. You bring everyone into the process. Another case study, we worked with a large CNC tool manufacturer. Big problem there was they wanted to reduce maintenance costs, warranty costs. They wanted to improve service time, customer satisfaction. They started with one very, very small problem. We know our spindles are major causes of failure. Let's look at spindle speed and spindle load. 2 very, very basic factors. We think that will help drive enough visibility. Okay? The habit process of trigger, routine, and reward. When the system started generating the data, this is the OEM, looking to understand what's happening at their customers' facilities when they ship these machines. They started building the habits of looking at the data. And how that happened was every time spindle load or spindle speed would exceed 100%, they'd get an email. And it was a trigger to say, hey, log in, something non-standard is happening with the machine in the field. Eventually, as that habit built up, they began to see patterns. When enough triggers came up, they said, well, this is happening more often than usual. And the reward was they were able to then use this to understand why that was happening. It happened at the start and end of the machining process, and they were able to modify the code so that the machine never rated tolerance. Because when that happens, it reduces the life of the machine and causes failures. Very, very small cycle, right? Very small habit building cycle. Then they said, well, this was great. I can now use this data to recreate what was happening with the machine at any time. Let me take this from my test facility down to a customer's facility. And then let me take that from there to the rest of my customers. It starts small, builds the right habits in a small way, and expands from there, right? So think about technology, people, process. The right technology to solve one small problem, got the people involved, reported the data back to the people so that performance improved exponentially, and with the right triggers and the right cues, it built the habits for the system to change overall. Think about how you do this in your own facilities, right? When you bring in a new technology, how do you think about technology, people, process to help drive change? So let's kind of bring this home. What does this look like when all the trends that Jerry talked about in Industry 4.0 and manufacturing technology revolution and this process of driving change, what happens when it comes together? And I've got two examples, one from a different industry, and then I'll bring it back to manufacturing. Let's look at the advertising industry. And I'll let you think about the technology, people, process in here as I walk through this. 50 years ago or 30 years ago, advertising used to be based on demographics, right? So if you were a 25 to 34-year-old female who made less than $70,000 and lived in New York City, assuming that's New York City, you were all in one bucket, right? The assumption was, for marketing purposes, you behave the exact same way, and you will market it to the exact same way. Where are we now? Advertising companies or marketing companies have been collecting a lot of data from cell phones, social media, behaviors, all these things we do on the internet to help build a model of one. Privacy aside, what that's allowed the advertising companies to do is help market to you as an individual. Right? So if I go furniture shopping online, or if I'm just looking at a new desk for my house, for the next 2 weeks, all I see is ads for desks, right? Because the advertising companies know I am in the market to buy a desk. As a consumer, yes, I'm concerned about privacy, but at the same time, I get targeted ads for what I really care about. And maybe that's just the millennial in me. I know privacy is gone, right? I get focused content. I get to see things I really care about. The advertising industry built this model of one and transformed the entire industry. Right? A lot of technology, people, process happened over the last few decades to make this happen. Let's look at another very parallel example in the world of manufacturing. GE, big manufacturer of jet engines, and has been for several years. How many of you know GE no longer sells jet engines? I see a couple hands go up. GE does not sell jet engines anymore. GE leases them by the hour. Same scenario. 30 years ago, maintenance on jet engines used to be based off of a part manufactured in a particular facility, particular model. The assumption was they would all behave the same way. When you go buy a car, the manufacturer says 5,000 miles do this, 10,000 miles do this, 20,000 miles do this. They don't take into account whether you're off-roading, whether you're driving on the highway, whether you're driving in the city. Same with jet engines. GE said, this is not good enough. Let's collect a bunch of data from these jet engines and help create a model of one. So now I know how every single jet engine behaves in the field. So same engine, same airline, may have had a different history of flight, different history of maintenance, and I can use that to conduct maintenance at an individual engine level, not at a fleet level. And what they did with this is not only did they transform their own manufacturing process and their own business practices, they ended up transforming the entire industry. The entire jet engine supply chain now behaves differently. And now they're pushing down the supply chain to say, we want to understand part level traceability and quality across the entire supply chain. Because I want to know, same bearing in these engines, vendor A versus vendor B, why do these two behave differently? And that's where for the mid-market manufacturers, it levels the playing field, because now that's a business problem you can go after. It's not about technology, it's how do I drive quality, traceability, and transparency to my customers down the road, right? Start with that business problem, one problem to pick. How do you bring this to your people and bring them into the process? And how do you build the right habits? So I will end with that and open up for Q&A if we have time. We're over time. Any burning questions? Otherwise, we'll be around. Thank you. Thank you.
Can you give them their cards? The cards, they're on my, right in front of me. All right. Next up, really excited to have here with us a couple of our clients, RCO Engineering. And I'll let Jeff Semick come on up, and also Eric Haas from Continental Structural Plastics. I've had the privilege to work with since 2010, and pretty amazing story. Obviously, both of these companies, when we think about middle market and innovation, these are two of our clients that I think about that have really pushed the limit, diversified, changed, broke through barriers to become very innovative companies. And recently, a few years ago, public knowledge, Continental Structural Plastics was sold to Tigen. And it's even more accelerating their growth to innovation. So let's welcome Jeff and Eric up. But first, before I get started, I can't make this up, but just last Thursday, this happened a little earlier, but RCO was on CNBC News, and they were interviewed at their facility talking about manufacturing still okay. So let's take a look at it. I'm going to cut it out, because it goes on a little bit, but let's take a look at it.
When we look at aerospace and automotive and defense demand, it's really on the rise right now.
With over 400 workers, RCO is one of the largest employers in this suburban county on the outskirts of Detroit. The company makes parts for planes and cars.
And turning it into an aerospace component, so it's super lightweight.
And RCO General Manager Jeff Simic says business is good.
Yeah, no, we're very optimistic here in Michigan.
It's not what you might expect to hear.
Slips in contraction territory.
The headlines around U.S. manufacturing have been less than cheerful. In September, the Institute for Supply Management's Manufacturing Index hit its lowest point since the Great Recession. The Fed says manufacturing output shrank over the last 2 quarters before slightly rebounding in the third quarter.
We're restoring the glory of American manufacturing.
Many economists blame President Trump's tariffs and trade war with China for manufacturing slump. Industrial states like Ohio, Michigan, and Wisconsin were critical to Trump's 2016 win. And no place is more crucial than Macomb County. Unlike the rest of Michigan, it has a mix of Democrats and Republicans. In close contests like 2016, it's the state's deciding vote. The last 7 presidents and Michigan governors have won Macomb County. Which brings us back to RCO Engineering. Economists are pointing out the fact that manufacturing is contracting, and manufacturing is something that President Trump talked a lot about on the campaign trail and also while he's been in office. But here, there's still a lot of support from the president. Would you say that's true from the people that you speak to in the
Yeah,
industry?
so it's very true. Obviously, our 20% of Michigan's GDP is in manufacturing, right? So it's very important to the people here, and I believe they do support the president.
And the sentiment's the same out on the shop floor.
Support for Trump is very, very positive. We have a lot of suppliers in the Tri-County area and over the west side, Grand Rapids area that we deal with. And, I'm out with that a lot, and, everybody's still very much on this. And we also support the China. The negotiations are going on there.
Just a few towns away, and
That goes on for a little bit, but as you can see, manufacturing is still pretty well. We're doing pretty well in Southeast Michigan. And, I contribute that, certainly at our RCO and CSP is, innovation has been a big part of that. Jeff, why don't you start out about your role and, in really taking on the diversification of RCO into aerospace?
Yeah, so the aerospace diversification was a big innovation for RCO. So one of the things, and we learned a lot from that aspect of launching the business, and we look at 5 things moving forward when we talk about innovation. First and foremost, resources. You know, do we have the right resources in play to manage this new innovation? Processes, do we have the right policy, procedure, and work instructions that align to this new innovation? Value, that's a big one. Is the company valuing this new innovation? Because sometimes if the whole Army isn't valuing it, then you have a chance of risk there. The other thing that we look at is, do we have the right organizational structure? And if we have any weakness in process, values, or resources, then we might need a heavyweight team to support driving this innovation forward. And then obviously we also would need a passionate and purposeful leader in front of this thing to make sure that they, what we call our talent and our human capital is aligned to it.
Yeah, excellent. And Eric, obviously CSP has been dear to our hearts when we started working with them in 2010 and did a substantial amount of work before your time. I think,
It was, yeah.
Before your time, and fearless leader there, Frank Macker, and when we started with them in 2010, the company was struggling. It was not making money, and we came in, fixed it all up, and we worked very closely. We were very fortunate to work with their team, and we did a lot of, at that time, plant consolidation work, right, and streamlining the business. But it was really, Frank's vision was that when he came on board, and I was very fortunate to have a real nice relationship with him, is that he's like, we don't have enough scale, we have no innovation, and maybe you can talk a little bit about composite and what, kind of how the business has transformed from, I would say, a commodity type business to an innovation company.
Yeah, absolutely.
Yeah.
So first, I just want to say thanks to you and to UHY for putting this on. It's been a fantastic morning, been a lot of great presentations, and I've learned a lot, so thank you for that. The last 10 years has been really an interesting time frame for CSP. As you mentioned, the company was struggling a bit, and they brought some new management on board, Frank Macker most notably. And from that point forward, we've gone essentially from what was a $200 million company with about 6 plants after some consolidation to now we've quadrupled our sales, and we have 17 facilities. We've gone through 4 acquisitions, and we're now global. So we have businesses in Europe, we have them in China, obviously Japan. So it's been quite a change, and it took that strong vision and realization of Frank as a strong leader that we needed to do some things differently than we had been doing. And to be honest, that's what attracted Teijin to CSP, is that kind of innovative mindset of what they had been going after. It matched Teijin's core DNA. So
yeah, do you feel like CSP? That was kind of transformative. I remember those days. Do you feel like Frank really put in that innovation process, or how are you guys innovating today, or started that? When you think of the middle market companies in the room, thinking, I don't know where to start.
Yeah. So if you look at our history, it's interesting, and it goes back long before I've been with the company. So I've talked to some of the kind of old timers that have been there, and the company was originally part of the ThyssenKrupp Bud group.
Yep, that's right.
And so TK Bud was a large company, very innovative company. And they put a lot of priority on innovation as well. And then it went into some private ownership, and the economy got tough, and as typically happens, you try to cut where you can, and a lot of times, unfortunately, that's the innovative side. And so they went from roughly 40 people that were in the R&D development side down to as few as 8. Literally, who's my VP of R&D today, it was out cutting the lawn at his development center because they couldn't afford to hire someone to do it. And around that time is when they brought Frank in. And Frank is everyone who knows him realizes he's a big thinker. He's very bold in what he does, and he's not afraid to go big. And so he did, and he brought a lot of. He bought a company in France, right? Yep. He invested millions of dollars into, and again, this was a company that didn't have a lot of money to invest.
Double down.
What they had, they pushed in, and he worked with the board of directors and with the owner at that time and really said, this is critical. If you're going to make this business grow, it's critical. And so they went from borderline being bankrupt to being sold for more than $800 million, which is public knowledge, not too many years later. So
10 plus multiple.
Right.
That's correct. And that was, when we talk about that matrix that we have, is moving up that value chain, right? There was a company that was probably trading at a 4, maybe 5 multiple, and just literally doubled.
Yep.
Really a big part of that is because driven through innovation.
Yeah, and he did, we have those systems in place now and we follow them and we have, but it's a lot of things, right? You have to be in tune with your suppliers, you have to be really in tune with your customers, and you have to be willing to stay the course, right? Innovation is not a breakthrough moment. It's a long process that takes time to get through. An idea happens, but to make something that's really got value, it takes much longer than that.
Sure, we'll talk. And Jeff, how about, obviously, the big concern that we heard today and we've continued is talent. And how did, I don't know whether you can talk a little bit about some of the products on the aerospace side. That were very, to me, crazy innovative, but took a lot of talent. Certainly on the research side, and you had to break through a lot of barriers on one of your products that I know of. How did the talent? How'd you get? How'd you forge through that?
Well, I think one of the things that aerospace came to Detroit looking for automotive talent. At the time when they came, we had, it was 08, 09, so we had plenty of, a bit of excess talent laying around. And so in the end, that's, they came for talent, technology, obviously speed to market. Automotive runs a lot faster than aerospace, and obviously productivity because of the productivity issues going on around the world. But anyways, we had talent then. Today, it's obviously a different story. We're going to be launching, as you can see and hear today in the conference, that we've got process technology, we've got product technology. We're going to be launching technology for the rest of our lives. And we talk about aerospace as a 8-year backlog in jets, but think about the backlog on launching technology. And so we focus on building our own, but we also tap into the K through 12 talent pipeline, because I think that's important to experience what they're doing in this day and age. They are becoming far more productive to society as a result of some of these programs that are out there. First Robotics being one of them. There's quite a few good ones in the state of Michigan. I think we spent a lot of time with that. But we can't necessarily wait for them to get here. But in the end, so in the middle, we're growing our own talent.
Awesome.
Yeah,
how about at CSP? What do you see on the talent front?
Yeah, it's I mimic a lot of what Jeff said. We do a lot. We sponsor First Robotics as well. We're very involved in that as a company. I think that's really important. Where we struggle is finding the people that have enough experience for what we do. A lot of what we focus on is really complex things, right? It's a lot of chemistry. It's a lot of complicated processes that aren't the same every time. And so what we're finding ourselves needing to do is hire really talented people, but they don't have a lot of that experience. So we have to bring that into there. We have to teach that to them over time. So we're developing a lot in-house. And more and more now, we're starting to focus on people who understand IoT and deep learning and big data, because that is a huge part of what we're trying to do. It accelerates that development process, because things that used to take us years to understand the complex interactions of what was causing a problem we were having, now big data and deep learning can find that for us much faster, and that's great. The hard part is that it's sometimes a needle in the haystack when you're trying to find that person, and oftentimes I'm competing with you all trying to find that same person. So, it's definitely something where we need to, as a community, with the colleges and with the schools, really kind of continue to develop that skill set.
Eric, could you tell us a little bit about kind of a new and exciting product that is in the marketplace?
You're talking about the Carbon Pro?
Yeah.
Yeah, that's exciting. How many of you guys have seen the Carbon Pro box? Anything on it yet?
It's on
All right,
the,
so
it's
it's on the GMC
Sierra.
Yeah, it's on the GMC Sierra. It's a program that I know quite well. I started working on that program with Tajin about 8 years ago. So, it's one of those things that it's like it's an innovative product that really took 8 years to come to market, right? So it's that concept of it's not a moment in time, it's a journey. But that box is really incredible. I encourage you to take a look at it if you haven't seen it. It's a first application of carbon fiber in a pickup box application. It is a really, really tough box. It's the toughest box in the market today. You guys may have seen some commercials where General Motors is showing different things happening to competitors' pickup boxes and the impact of that. And a lot of that started because we were working on that box and they knew that this toughness was there. So it's quite exciting, and aside from the product itself, the technology of manufacturing is also very exciting because what typically in carbon fiber, right, we've gone from autoclaves that would take 2, sometimes 3 hours to make a batch of parts, and have gone into out of autoclave technologies that are 20 minutes, sometimes 10 minutes. Now they're in the 5-minute time frame. This technology is literally 60 seconds. It's thermoplastic based, so it's much faster to process. And that means that the number of parts we can make from a set of tools is now close to 200,000. And so what that does is enable composites to be used in more and more vehicles. So it's very exciting. And I think it's another great example of where it's not just lightweighting. We took 62 pounds out of the pickup box, but we were able to use the composite material to its full advantage and create toughness that isn't possible with lightweight materials, lightweight metals specifically. So.
And you use that same kind of process technology. I remember back, that's been probably 5+ years, was the next gen Corvette.
Yep.
That's now, right?
Yep.
That was, if you guys can't get 25 to 30% of the weight out, you won't be getting the next gen Corvette.
That's right.
So that really was okay, we better figure this out.
Sometimes necessity is an important encourager for innovation, no doubt.
Yeah, that's for sure.
Yeah.
Jeff, so where do you see kind of what's the next phase, or where do you see RCO as far as on this innovate? Where do you see you guys, the company going?
Well, we see obviously in the industry a lot of customers wanting differentiation, customization, and that's key in aerospace as well. There's fleet-driven, aircrafts are fleet-driven. There's a scenario where autos could be a fleet-driven scenario. And those people managing the fleet want differentiation. But nonetheless, we're focused on a higher mix, lower volume, and becoming really good at it. And one of those things that's going to help us, we're trialing use cases for the Industrial 4.0 scenario. We have additive manufacturing. In our plant, we have manufacturing execution systems. We have machine monitoring going on. I'm not saying it's going on across the entire company, but it's important to exercise those use cases so that you can start piecing things together. And then we're always forward-thinking, our manufacturing engineering group, relative to, how can we do more with less? Because the volumes of things are coming down, and how do we get there without buying a bunch of heavy automation, right? So we're really focused on, looking at cobotic solutions and really making use of human capital in the low volume environment. And obviously tying into the human capital as an asset is important when you have more humans out on the floor. And I think there's a lot of room to grow there, a lot of room to, we always used to say, well, geez, we want to, the robots never cry and they always come to work and all that. But, in the end, we're focused on, how do we improve the human asset and driving it through efficiency and basically connecting to them.
Yeah. I know your company's going through an ERP implementation. I know Debbie, I don't know if Debbie's here, I know she's having a lot of, she really enjoys that. Pretty easy stuff. But those are great steps of replacing legacy systems, right? Moving up the disruptive chain. and kind of on your path of innovation. So.
And I think the other thing that we continue our diversification in aerospace. That's been key for us, especially as we see different industries go up and down. It's something that's been a good baseline for us, and so we tend to encourage folks. We brought 30 suppliers on when we brought aerospace into the market too, or brought our products into the aerospace market, and so they're also enjoying that. They're here and they're all local.
Yeah, and you've took on a big initiative with AIAM, which we're a member of. I believe Tony's here.
Yeah, Tony's here.
For those interested in the aerospace industry, it's a fairly new organization with, tremendous off to the start.
Yeah, no, that's going really well. We've got over 100 members, a lot of small to medium enterprise, but we're really, that association's driven by some big brands in the state that people don't recognize.
Sure.
They were talking about those printed fuel nozzles, plexiglass. That's happening in Zeeland, Michigan.
Yeah.
That's where it's happening. Woodward Aviation has their advanced metal additive printing there. But we also have Pratt Whitney and Lee Baer and Eaton Aerospace and some of the other names mentioned today. So that's good. But thank you for throwing that out there. It's www.aiamnow.com.
Yep. I believe Tony is. I don't know, is Tony still here?
Yeah, he's around the corner.
Raise your hand if you need to reach out to him. So, in closing, what advice could you give? What do you think is a place to start for middle market manufacturers? What would you recommend?
Well, from regarding innovation, I think that it's important to take some time to look at, from a macro perspective, your resources, values, and your processes. A lot of that came from the Harvard Business Review Essentials that we read into, and we thought it made a lot of sense as we were going through the innovative aspects. But anyways, I would suggest that.
Yeah. Eric, anything to add?
Yeah, I think from my standpoint, we start with a business case in all of our innovation, right? And sometimes that's hard to do because you're maybe looking at a new product that you don't know about. But in everything we do, you need some kind of an understanding of what that market's going to be, because in many cases the investments are huge. And so we need to make sure not only that we as an R&D group understand that, but the whole company understands that, and that sales is bought into that, that manufacturing is buying into that. And that's an important aspect of what we do. And so I wouldn't diminish that in any way.
Perfect. Do we have any questions for our panel, for Jeff or Eric this morning? No questions, no news. Well, thank you very much. We really appreciate it. And our last presenter of the morning, which I think you're going to find extremely innovative. Robert Nemec is a managing partner of Twist Think. They're located right here in Holland, Michigan. I'm not going to steal his thunder. I'm going to let him talk a little bit about the organization. But, when you look at a lot of our companies in middle market don't always have the resources or to know where to even start. And Twist Think really has a process and a track record of helping companies innovate their products. So I think you're going to find his presentation fascinating. I encourage you to reach out to Bob following the presentation. So let's welcome Bob.
All right. Thank you, Tom.
Thank you.
Rearrange the furniture a little bit so I don't trip and fall. Good morning, Detroit. You made it through the morning. You're a little bit weary, but we're going to try and rock and roll in the next 20 minutes. I promise to try and be brief and bright, and then we're all going to be gone. So get ready for that. Certainly before I get going, I just want to give thanks to Team UHY and giving me the opportunity to join you this morning. So thank you, team, and Jessica and Chris. And, these events always have a large team behind them. And I just want to give you guys compliments. I'm sure there's more behind you that have worked really hard to have this thing roll. So kudos there. I'm just winging it by doing that, so hopefully I didn't mess you up, Tom, at the end. I'm sure you had that in your notes, too. So that was one point. And then really, I guess the other point was going to be just to the previous speakers. Great job in your efforts. And I think you'll be encouraged to hear and see some consistency between each of the presentations. So we're all here talking about leaning into change and innovation. And hopefully from this slide deck of 20 or less, you'll see that with me and the great team that I represent, this is a hot spot. This is something we're pretty fired up about and passionate about. And I'm excited to have the chance to share it with you. Before we get going, I've asked my new friend Chris to come up. This is a chance for you to, if you're a little bit drowsy, I got 2 questions in which you're just going to give a simple hand raise. If you're super fired up and answering, you can give 2 hands up. But the question is this: how many of you have previous experience yourself or within your organizations when it comes to lean manufacturing and the process that entails? Raise your hands. Come on. Big, yeah, there you go. Fire up. Hands are up. You got them? Cool. Here's the next question. Maybe the same number of hands will go up, and that will help inform me in knowing my audience. Hands up if you have personal training experience, either yourself or within your organization, in the process of human-centered design. Come on, hands up. There you go. Houston, we have a problem. And hopefully at least before the end of this or at the end of this, you will be a little bit better informed. Thanks, Chris. I don't need a picture of myself. I wanted a picture of you all, not of me. I don't need any more of me. But I'm hoping to introduce you to that process and perhaps even inspire you with that process. So here we go. Let's roll. Four key steps we're going to roll through in the next 20 minutes. Why innovate? No surprise, and I think we'd all resonate on that point. A proven process that's not called lean manufacturing. I want to expose you to that today. The digital opportunity, we've heard a lot about that already. I'm going to touch on that as well. And then the call to action. You can't have a good meeting without a call to action at the end. You all know that. We all know that. So let's go. Why innovate? Great quote from a mid-market, perhaps some might call a large market firm, Roger Milliken, the guy who rolled that organization many years ago, based in the South Carolina, chemical, textile, global player, and a dominant force in a lot of marketplaces, in particular automotive being one. Is there a player there? Anyways, the quote really resonates with me and hopefully with you. Operational excellence secures the present. Innovation excellence secures the future. Smart companies, your companies, have got to do both. One without the other is not going to lead to the dominant presence that I think we would all desire to have in our respective companies. Both. Interesting story about this company and that gentleman and that great quote. He was one of the first companies in the late 80s to receive the much esteemed Malcolm Baldrige National Quality Award. Some of you older folks maybe remember when that hit the street in the 80s. He was one of the first. And so I give him a lot of credit. And this quote hangs still, though he has passed, it still hangs in the entryway to their corporate center. I give him a lot of credit to appropriately emphasizing both, not just quality and operation mindedness. Okay? So that's point one. Here's a simple graphic. Where are you and your team on the graph? Are you above the waterline, in the fresh air of innovation, or are you below the waterline at some point? It's important that we look at it that way and, in a sense, examine our heads and our hearts to really assess, where is my team? And this question doesn't just apply to the great manufacturing companies in the room. I know there's a lot of great service providers too. Banks, lawyers, I don't know. I kind of see the trend where you might be towards the bottom of the iceberg. So this domain of innovation isn't, that's for the manufacturing folks to figure out. It's a service or it's a product. I'd even pile on, based off of some of the previous presentations, that our education system, where is innovation applying there? It hits us all. HBR just a few years ago confirmed, though most companies, most leaders would say, my team is innovative. The data would indicate, they talk to thousands, privates, publics, only 9% is what they found are doing any serious kind of innovation. And for somebody born in Detroit and operating a business in Michigan and serving a lot of great clients coast to coast, but many in the Midwest, I think this is a problem, but it's also a great opportunity. So the battle cry today, it's amazing. I only met UHY earlier this summer, and it was coming out of Gordon and then Tom quite quickly that we're trying to get our head around the space of innovation, which leads us here today. I have an encouragement for you. There is a process. Smart companies adopt the process I'm about to show you, and I don't care what industry you're in. I don't care what size your revenue line is, this process can be deployed for your benefit. By the way, I didn't say this at the beginning, I failed. I represent a team of 50 that for the last 20 years have been serving a variety of markets and a variety of clients, one being one that Tom mentioned earlier, Overhead Doors, that company that went from Indiana to Texas, that's our client. And this team has been serving them and many others in the domain of innovate, accelerate, and grow. If I were to ask you another question right now, I'm pretty sure we'd have over 200 different answers to define innovation. Nobody freaking knows what that is. Innovation is an outcome. Creativity and imagination are skills that lead to innovation. You can't call something innovative unless, what? It's been commercially successful. Otherwise, it's just an invention. It's just a patent. To be innovative, you got to make an impact in the marketplace. I think that's what's driving all of us today. Onward we go. A proven process. This is not it. This one's already been proven for decades in your company and thousands, millions, really every company around the globe. Everyone knows about lean. And it's a great process. It drives towards operational excellence. It reduces waste. It reduces safety incidents. It allows for continuous improvement. No problem at all that process makes a ton of sense. Milliken is fully into training everyone in the domain of lean. There's tools, there's methods, we all know them. We could recite them to each other afterwards. Cool. There's another process, though, that's just, bless you, just as good. Human-centered design. By the way, the previous process, I would argue, is very much a left brain, linear type of process, very analytical. So engineers, accountants, you name them, they can drift into that space and feel real comfortable. I'm an engineer by way in my training, in my undergrad, so I get it. Human-centered design is a right brain skill. That's the side of the brain where creativity and imagination tend to thrive. But it is a process. You follow this process, I guarantee you're going to have better outcomes. It's been proven by more than just this team called TwistThink that's been doing it for 20 years. It's a well-known, documented fact. Most leaders, however, are a little bit uncomfortable with the creative side, if we all just kind of transparently share that fact. I don't want to go there. I'm about efficiency and linear process, and I want to know where the heck it is we're going before you would even take me on a journey. That's not going to work with this process. And as leaders, small company, Fortune 100s, that needs to be embraced. The process and the uncomfortable nature that goes with it. But just like lean, hey, guess what? We got tools. We got methods. You deploy those tools at the right tool at the right time, you're going to dominate. Think about it. Let me just go on one step further. Here's showing innovation, front-end innovation, HCD, design thinking. Those are all battle cries that go with those first 4 steps. And then we know what follows: product development, service development. Smart companies do the first before they jump into the next. Most companies running on the fuel of lean manufacturing, they just go back to the start of the product development phase and say things like, I don't have time, I don't have money, I don't really care what our customers are saying, I know what our customers want, let's go pick a technology and jam it into our product, they'll be happy, trust me. That's a sham. Smart companies invest in HCD before they get into product development. Leaders struggle with HCD because most leaders, if we're all honest with each other, we want to know where the heck we're going. But somebody highlighted earlier, I think it was Tom, the slide that talked about adjacencies. That's how you get into adjacencies. Apply HCD to what you're already producing and you already know well. You can get into adjacent spaces. You can get into transformative spaces. If you want to just keep cycling through and skip HCD, well, then you can innovate within your core, but it's only going to be incremental. You're not going to transform your clients, user experiences, your own team. You're not going to get into new markets. And right now, I would say we're a little bit at risk because we've had a decade of economic growth. So the reality is, if we're all honest again, man, we just keep turning the crank and printing the money. I'll worry about that next week. Okay? Somebody else showed lenses, so right on, brother. I've got some lenses too. And these lenses, just taking it one click down on the HCD side. What is it? It's a strategic problem-solving problem. Strategic problem-solving tool, excuse me. Right? It starts with those 3 lenses: usability, desirability. The what? That's customer-focused. That's stakeholder-focused. 2 is technical feasibility. The how. How are we going to do it? How are we going to deliver the what? And then, of course, business viability is a key part of that too. How are we going to make money? How are we going to make new money? It hasn't really been talked a lot today, but the notion of innovation is also targeted not just at the product, not just at the service, but the business model. The reference to GE and how they're leasing engines is a great example of business model innovation. So that's HCD, one click down. Smart companies, your companies, need to put the stakeholder or stakeholders front and center. That's why you see that lens magnified a bit. Startups, technical startups, tend to run with the flag of, I got a patent. Established companies, perhaps some in the room, tend to run with, what does the spreadsheet tell us our ROI is going to be? That will drive our behavior. Not that ROI is a bad thing, and not that technical feasibility with a great patent is a bad thing either, but boy, oh boy, the number of leaders, the number of companies that we come in contact with that have lost sight of their customers is alarming. And you can't just rely on what everybody's got a high on right now, data. You got to go talk to them. You got to go tease out of them where they're at and where they're trying to go. Yeah, data is useful, but it isn't just a data play. Trust me. Here's a slide, simple. The numbers don't lie. You invest in the skill of design, either internally or some fashion externally, and you're going to see your returns grow. And they're going to go faster than the marketplace. The problem is, we're all left-brained. And that stuff, that visualization, imagination, the process of unpacking the needs of stakeholders, I don't have time for that. I got to respond to a tweet. Freaking joke. Right, so I'm just rolling with you. And I guess this slide, I mean, it's kind of comical. We're talking about human-centered design. One of the best schools in the world is like blocks from here, right? You guys all know that school? Center for Creative Studies, training young talent, young minds from all over the world come here to go to that school and learn that process that I just referenced briefly for you. It's a game changer. If you forget everything else that I've shared with you today, just take away that fact that as you're trying to innovate internally and lead your organizations internally, make sure you build a cross-functional team that has industrial designers sitting at the table with the rest of your group. Every company, product, service, school. I'm not an industrial designer, by the way. I've been connected to them for over 35 years of my professional life, but I'm not one. I'm that linear guy. Every company of any size can be transformed, can grow their value with some access to that talent. Okay, so that's chapter 2. Chapter 3, we're rolling. We got to get out of here. Digital. Digital, digital, digital. So we just talked about a smart process called HCD. There's a smart megatrend called digital that you've already heard is disrupting every market, every industry, and every company. So this should be like eye-brightening to you that, man, if I'm below the waterline, maybe if I grab onto HCD and grab onto digital, I can go somewhere new. McKinsey, you know, we all hear the McKinsey posts, see them. 43 billion, that's a lot. That's all I'm going to say. Even if they're half off and it's 20 billion, it's still a growing market that is huge. Last week in Chicago, they had a whole week dedicated to ideas. It's an event they've created over the last few years. I'm sure we have something like that here in Detroit too, but it was cited last week that the number of connected devices has now grown beyond the number of people on planet Earth. So, I don't know, 7.5 billion is the count right now. There's more connected devices than people on planet Earth. And McKinsey and everything else you read in Wall Street and whatnot, every company probably in this room has digital somewhere on their roadmap. This train is not slowing down. And so that should fire you up. Go digital. Figure out a way to go digital. If you're a service company, figure out a way to go digital. Just as a reference point, because we've thrown around industrial IoT and IoT and a simple schematic, here it is, somewhat captured. And again, when I say digital, I'm speaking to IoT, I'm speaking to AI. You can kind of, for the purpose of this conversation, pull them all together. But it starts with edge devices. Edge devices on people, on moving assets, on fixed assets, on spaces. But it's deployment of edge analytics and connected device that is creating what we now know as the digital revolution. By the way, just speaking to digital and back to HCD and user experience, that gentleman, Jim Hackett, leading Ford, would say in a recent quote, we're no longer, of course, in the industrial age. We're no longer in the technology age. We are in the age of user experience. The reference earlier to millennials, that's all they care about. And they want to be a part of teams like yours that are going somewhere into that space. So you want to attract talent, be innovative simply as a marketing strategy to hire more talent. Nonetheless, starts with an edge device. Edge device talks to the cloud. The cloud is where the brains are. AI is reigning in the cloud. So now that data that's collected in incredible volume can now create new user experiences for the people. Simple, intuitive, beautiful data that you can act on. That's where we're at in today's economy. Here's a great example of that hitting the street as we speak. The company is Flexco, 100-year-old, private, mid-market, based in Chicago. They live and breathe in the mining industry. Their product could be summarized as belt cleaning devices. So if you're a mining operation, that belt had better be running 24/7. Kind of like for those of us with automotive experience, that assembly line had always be running, and if it ever goes down, heads are going to roll. That's what happens in the mining industry when that conveyor stops. So Flexco's product is keeping that conveyor belt clean. It's the classic model of razor and razor blade. So they have a frame that mounts to the conveyor system. And then they have a blade that is actually scraping that belt clean before it cycles back down into the mine so that you don't have debris falling on the precious capital. That's all they do. Those blades wear out. Flexco wisely said, how can we use digital to create a new experience for the mining company? Because the calls coming in that say your head's going to roll because your device was worn out and not replaced in a timely fashion and it shut down our mine, those calls are a little bit cumbersome, especially when you're talking about 8 hours in the bush of Australia. So that's where digital comes in. That's where the process of HCD comes in. And it starts with, hey, let's go discover. Let's go analyze. Let's try and make sense of it all. And who do we put first? All the stakeholders, the dealers, the sales guys, the distributors, the mining company leaders, the leaders and team from Flexco. You've got to use the talent of design and the tools of HCD to pull out pain points, document pain points, and try and make sense of it all. That's what Flexco did, wisely did. For the first time, they mapped the life of their product from start to finish and visualized all the people and all the things that influence that journey. When was the last time you visualized your product roadmap? Hugely important. When was the last time you visualized your service roadmap? I'm emphasizing the word visualize because that's the talent of industrial design running alongside of a lot of left-brained operators. And oh dear, is it a game changer. So discover and analyze, understand the product, understand the stakeholders. So you see them outlined into 3 buckets. The mining company, there's more than one person in the mining company. That's a stakeholder that Flexco needs to serve. Same goes for their dealers and distributors. And same goes for the Flexco organization. So all are benefiting from data and all are benefiting from a new user experience. The result? Here's a mechanical company. They've never done anything in the digital domain in their 100 years. But they're turning on the lights this month with a system that's comprised of those 3 pillars I referenced earlier. Edge device. So now they're going to have technology living in mines around the world, collecting data on the life of their blade. So that, guess what? No longer is it taking a phone call. Now Flexco and the dealer in Melbourne can respond to a mine before a call even needs to be made. And he protects that razor that's been deployed. One of the issues that Flexco had is, hey, they would install a frame, their blade, walk away, come back in 6 months, somebody else's blade is on their frame. That kind of hurts. This is going to put a bullet in that. And for, again, back to an earlier reference, for the first time, they're now selling service contracts to go along with their product. So business model innovation is coming out of the digital revelation that Flexco was on. So it's edge device, it's cloud, and it's new user experience. The mining company is getting alerts for the first time. That is the power of digital. And I think, though I don't know all of you and I don't know the companies that you're connected with, I'm willing to bet that there's similar stories that one day, hopefully, you can tell within your organization. So the call to action, the take action, we're almost done. But this slide really emphasizes a great quote about discovery and then continually reinventing. And so my encouragement to you is, boy, oh boy, use HCD, use digital, and go discover and reinvent. And then when you do that, do it again. And don't stop reinventing yourself. With that, I have a 90-second, very brief video that I want to share with you. Again, simply just to get you fired up in terms of the space of digital. Okay?
Connectivity. We seek it from the moment we enter this world. Connections bring us together as friends, as family, as people. Being connected helps us be closer when we want to and disappear when we'd like to. People seek connectivity in every part of their lives, and you have the chance to provide it for them. As many companies embracing digital know, connectivity isn't always easy. That's where we come in. At TwistThink, we've been living and breathing digital for decades. We have a process that helps our clients imagine, design, and commercialize products and experiences that bring surprise and delight to their customers. We were connecting devices before the Internet of Things was even a thing. Maybe that's why we currently have over 100 million connected devices in the marketplace. Whether in healthcare, industrial, transportation, or any one of the countless businesses surrounding us, your customers want to be connected with their work, with their devices, with each other. So, if you want to connect with them, we invite you to connect with us. Now is your chance to boldly change. Let's go.
So, thanks for watching that. Thanks for hanging for the whole morning. I guess leaning into change, I would simply leave you with innovate, accelerate, and grow. Thank you very much.
Thank you, Bob. Thank you so much. You know, when we think about, I think Bob was being a little modest. Their company has made, there's a huge number of innovations that they've worked on for a lot of companies. And if you really, it's that process, when I think about our middle market client, it's hard to do it on your own. And you know, if you're looking for someone to help you with that along that path, they got quite a great proven track record and some great stories to tell. But overall, I wanted to thank everybody for joining us today. Another successful event. It's actually our largest attendance. We had to cut it off this year because the fire marshal was going to come get us. So, you know, that's really outstanding. And we made it through. We didn't talk about any new accounting pronouncements or taxes, or we didn't have Paul talking about international tax this year. So, you know, we try to change it up every year. You see this year, you know, it was really about you, you know, and, you know, it's not only the deep resources that we have within our firm, but it's also really the resources that we in our network around us. That most importantly is we're only as successful as our clients are. So we hope you saw the value in today's program. Some of our speakers are still here. And again, we want to thank you. And again, a big shout out to marketing team and Jessica. I know she went above and beyond this year to make this a great event. So thank you. Thank you so much. And literally, we're like right on the button here. So thank you so much. Enjoy the rest of your day. Oh, I didn't. Oops.